We did have a village board meeting that just ended. This is I'd like to 7:12 call this finance committee meeting of the village board to order. Clerk Waters, would you please take the roll?
Trustee Eater?
Here.
Trustee Struck?
Here.
Trustee Tagliafico?
Here.
President Skaman?
Here.
Citizen Advisor Greg Kolar?
Here.
Citizen Advisor John Hedges?
Here.
And Citizen Advisor Bridget Allen Hedgeman is absent.
Thank you. And we do have colleagues in the audience as well. And so if you have any questions at any point, you can ask, just so you know.
Okay, the pressure.
Get called out publicly. I appreciate the work of the committee, operating as a committee. It's a lot, and I'll just say that out loud. Do we have any non-agenda public comment this evening? I'm sorry. No? A none? And looking for anyone to interrupt me. And then I don't see an approval of the agenda on this one. So we're moving forward to, but that's fine. I'll entertain a motion for the agenda as it's presented. It's a committee though, so I think we're good, right? Yeah.
Yes.
Yes. Yeah. Very good. There's been no objection. How's that? New business, a continuation of review of recommended 5-year. Oh wait, we have a slightly different order. What's Manager Jackson?
Yes.
I do still have it. How about that?
Okay.
So we're going to be starting with...
We're going to start with item C.
Okay. Review of the PEG amount of the current sweep account and to discuss adding the sweep capability to 2 additional accounts. Wonderful. Thank you.
Yes. Yeah, so Donna Gayton, interim CFO.
Good evening, everyone. We have Kyle here from Huntington Bank who's going to go over the PEG amounts. These are what we discussed when they were here before. And so we want to get an approval to move it to the board to change the amounts.
Wonderful. Thank you for joining us.
Thanks for having us. And you all know me. I was here at the last meeting we discussed this. I wanted to introduce Steve Abbey as well on our team in Huntington.
I run the government nonprofit banking business for Huntington. I live here in the Chicago area, and thanks to be your service provider for the village for a long time.
Wonderful. Thank you for joining us, Trustee Wesley.
Thank you.
So, I believe everyone's received this document. Last meeting I was here, I talked a little bit about high level about how the bank accounts are set up, and we got into some of these recommendations that you see at the bottom, which is really what we want you to focus on and consider for this meeting. And there's really kind of 2 big picture recommendations. The first is to generate more interest earnings for the village. We would recommend reducing the PEG that is currently on the corporate money market account to $25,000. That those funds would then sweep into an off-balance sheet money market fund that would be consistent with the village's investment policy. And additionally, in order to generate more interest income, we also looked at a number of other accounts that have significant balances. One being the motor fuel tax account, that's the 8742 account, and then also the concentration account, which is the 0193 account. I believe last time we discussed as well, there is another account that has significant balances in it, which is the Community Development Block Grant account. That account is not eligible to earn interest, hard dollar interest, so we are not recommending that you add a sweep there. But adding it to those other 2 accounts that we didn't discuss last time, we think would be beneficial to the village. So That's one of the high-level recommendations. The other one is to add what is a fraud prevention tool called GUI-ACT, and that is really meant to strengthen ACH payment security. That's something that a lot of municipalities have implemented in large part due to the prevalence of business email compromise that we continue to see in the financial sector. So I'll pause there, but those are the two kind of high-level recommendations. It would be reducing the PEG balance for a sweep account that you already have, and then adding 2 sweep accounts or 2 sweeps to accounts that do not have a sweep in place today.
All right, thank you. Any questions?
This is what we discussed
It
last
is,
time.
yes.
Nothing's changed? Or
Well, there's some
They're
recommended
taking
changes.
action on it. They had, you suggested it, now they want us to
Oh,
move on
okay.
it now.
yeah, I was good with it then, I'm good with it now.
Okay, please.
If you don't mind. So I just have a couple questions. It mentions here about putting the CDBG balances to work. That wasn't explained. How is that put into work if the countered interest? Can you explain that? No.
So the balances that in that account have been they're being used to offset the banking fees.
Okay.
So that's kind of what we mean. It's that the money is still there to work for the village. It's just not earning
Right.
a hard dollar.
Would they have
interest.
been already doing that or no?
It's already been doing that.
So is there any change with that then, or is it the same?
Is that this?
Okay, very good.
I was just calling it out because it was a
It's-
significant balance.
It's significant balance, and it is. And your earnings credit rate is a half. Now, I think it was mentioned at the last meeting it was 0.2%. Is it 0.2? Was it 0.2 and you raised it to 0.4?
Correct.
So that's an increase
Yes.
on the earnings credit rate. That's for anything that's below the sweep, right?
Yes.
Yes.
As well as any accounts that don't have sweeps on.
Or that don't have sweep. So anything that, okay.
The
So it's
other
a half
accounts
a percent.
don't have meaningful dollars to these 3 accounts do.
Oh, yes, and that's a big move even for the items, the amount of it that is under, because there's significant, as you said, significant balances under the sweep. And of course, now reducing it, you're reducing it from 10 million now down to 25,000. So that's a reduction of 975, 9 million.
10 million minus 25,000.
That's a good way of putting it, right. So that's good. That's a benefit to the village, of course, because we can earn that interest that we weren't earning previously. So, and then the motor fuels tax, I'm surprised it has that much in it because I know it doesn't generate. It must be over a period of time.
I was going to say, yeah, these are last 12-month average balances, right? They do fluctuate over the course of the year, really any given month, depending on inflows and outflows.
And can you just explain one other thing, that the mention of 1.6%, that hard interest is paid on excess balances not exceeding the offset fees. What is that? How has that changed?
So basically, once the fees are offset using that earnings credit rate, then in aggregate they can earn a 1.6%. But that's small. That's like small dollars. It's not.
Okay,
It's only to the extent that fees are offset.
got it.
If the committee agrees to move forward these changes, that becomes immaterial. That 1.6 becomes no longer immaterial because all the balances that might have gotten
Are gone. They're going to be swept out because it's going to be 25,000. Okay, or less. So it's a small amount. Got it. I'm fine with that. What do you think?
Yeah. If there's no further questions, then it looks as if we've got a consensus of the Finance Committee to take this to the village board.
Yes, thank you.
All right, thank you for bringing this back to us for that action.
Thank you.
Thank you. Thank you.
So then next, we're going to hear from Spear, correct?
That's correct.
So that's a discussion regarding an ordinance for bond refunding. We stuck around for 45 minutes for 10, but thank you.
Good evening, everyone.
Okay, here you go.
Thank you.
Name?
Oh.
Okay. Might be the wrong one.
Yeah.
You can go ahead. I think the correct one is on your iPad. Can you send that? Can you upload that? Okay. Go ahead and start.
Okay. Good evening, everyone. My name is Rafaela McKenzie. I am with Spirit Financial. I am here tonight to talk about the village's outstanding bond issues. So currently, the village has several bond issues that are currently callable, which means that we can currently refund those bonds for savings. And so we periodically review these outstanding debt, and with the changing environment, with the Fed, cutting the interest rates twice already, and hopefully again in December, we continue to monitor these outstanding debt of the village. And of the total bonds that are outstanding, 6 maturities, series 15, A, B, 16, A, D, E, and 17 are currently callable. And so what we would like to do is to propose refunding all of those bonds that are currently outstanding and that are currently callable. And what that does is, when we go to market to refinance these bonds, the idea is to refund the maturities that provide the biggest savings to the village, or rather provide the most savings. And right now we're looking at setting a target of maybe 2.5% net present value savings. Your Series 2016 E-bonds at this time show the most savings, but with the lower interest rate and with the Fed looking to do an additional cut, we thought it would be a good opportunity for the village to get those bonds set up so that when the market is favorable, we can grab those maturities that make sense. And those maturities currently have interest rates ranging from 3.5% to 4%. And so, again, the village has the opportunity to refund some of those bonds. And so we have, right now we're asking for up to, it's just a max, $55 million. We've identified about 25 to 30 million that are currently callable, that currently show savings. Could that go down? Yes. Could that go up? Yes. But the idea is to have that window, that large amount, open and available to be refunded, and then we can go in and continue to review and identify each of those maturities that show savings to the village and are favorable. Your 2018 Thank you. Your 2018 on this chart, the lighter blue highlighted bonds are the bonds that we're currently looking at refunding. As you can see, all of them are currently callable, that are outstanding. And those are the ones that we're looking at that we believe the village can get some savings from. The 2018 A and 2020 A bonds are not currently callable, but based on the Tax Cuts and Jobs Act that was adopted in December of 2017, we can't touch those right now. So we would have to wait until we're 90 days or so closer to those call dates before we can refund those bonds as a current refunded bonds. And so if you move to the next, if you don't mind, moving to the next page, describes here why we wouldn't touch those bonds at this time. And on the second page, again, and I brought this up last time, we did talk about the two ratings that the village currently has outside of the AA with S&P, AA plus with Moody's. But for the refunding, the strategy is to only use one rating. And we're looking at using just the Standard & Poor's rating. Why? Because the idea is to keep the cost down as little as possible. And so in a situation like this, we can identify investors who are, in the market and will take the one rating for your bonds. And again, with having these rated, it shows here, for example, what some of your benefits are and what the opportunities are that are available to the village if you should proceed with this refinancing. The following page is basically a summary of what happens from here. So we would get our financing team together. That includes your bond attorney, bond counsel. That includes myself. That includes registrar and paying agent. Everyone who is in the rating contacts for Standard & Poor's. Everyone who would come together to, who are part of the financing transaction. SPEAR would prepare what's called an offering document or an official statement, which pretty much tells investors everything about the village. Everything, which include your taxes collected, your principal taxpayers. It has your financials. It has everything, your census information, everything that an investor would want to know, and that we currently prepare information on an annual basis anyway, and that we also provide to prior investors or prior owners of your bonds. And so this official statement, once we gather all the information, we go out to pricing. I'm involved in the process from beginning, whether it be structuring of those bonds, refunding, to day of sale pricing, through to closing up the bonds when those funds get delivered. In this case, refunding dollars. So those funds will go to the escrow agent to redeem the prior bonds that are outstanding. And if it's new money, then it will go to the village. But in this case, we're just talking about refinancing. So that's pretty much the process. Are there any questions or concerns?
Brian.
So, right now, with all of these different bond series, we functionally have a structure of over the period of the next 15 years declining annual payments. When we refinance, does that mean that sort of the entire debt captured by those 6 bond series will be on one payment structure?
So it will be one series of bonds refunding all 6 portions, and the idea is not to extend your debt, so we will remain within the parameters of your existing debt. But only one bond issue, one series, and the goal is to get savings in each year, which is a lower debt service payment than what you're already paying on your existing debt.
Okay, so savings in each year rather than more savings up front and more I didn't know whether we were looking at a flat or
so that's a good question, right? Because we do have the ability to give you those savings however you deem fit. So let's suppose the village says, you know what, we would rather take all our savings up front for those four, let's say the first 3 or 4 years. We can structure the savings to reflect that pattern.
Yeah, and I wasn't proposing that. I was just wanting to understand how it would work, especially since I know there's obviously been discussion around a separate bond issue going forward, and given that we are refinancing the biggest part of what makes us have those sort of declining payments over time, sort of figuring this out with the other bond issuance we're going to have, so that we have some we can anticipate and plan and have those payments maybe slightly go step in a gradual way that is predictable and won't cause massive jumps to the levy in out years would be useful. I don't know exactly how to structure that, but that's just one of the things I was thinking, because we've got this wonderful chart that shows how they're falling, and we want to be wise about how we're planning this, given that we expect there to be another bond issue.
I agree with that.
Me too.
Jim?
So I'm trying to understand, I guess, so you've got 6 different bond issues here, and you're going to put them into one, correct?
One bond issue. Correct.
One bond issue.
One series.
Well, we have maturities of 3 years up to 15 years. How do you account for that? How do you work that so that the average maturity is not changing?
So what we do, the system that we work with allows for the 3, 5, 10, 15, whatever it may be, to refund within those parameters only, within those years. So there is so you're not going to have a new bond issue with, for example, your existing 3 years being pushed out, right? Because that's not the idea here.
Right.
The idea is not to extend the debt, but to refund within those existing parameters. And that's the idea behind.
But it's one product?
So if you have $10 million total in 1 year of all the 6 series,
Right.
and let's say we have $500,000 in savings in that year, so that maturity for that new bond issue will be about 9.5, right? Because we're now showing that 500,000 savings, but it takes in consideration all 3 or 6 rather, exactly, of those existing debt and producing a debt service that's lower than all of those existing debt. So instead of Spear doing 6 bond issues,
Right.
we're just doing 1 because it's cheaper.
Sure.
It's less costly, and we can identify with this one bond issue in the official statement which bonds are being refunded, and we can and when we provide the reports, we can also show on the reports the individual savings for each series. So the details regarding of the 1 series of bond, we can provide to the village each bond series and what each bond series has saved, even though we did it aggregately.
And it does not impact the maturity at all, the overall of the debt. It's going to be still coming off in the same years.
Same levy years, your
Okay.
existing levy years, correct.
Yeah, that's interesting. So, and one other question I had was, you're estimating the savings, and of course, you don't know until we price them, right? What would it end up being? But 450,000, is that net of fees?
So we've been running numbers over the last several weeks, and we've seen some fluctuation. We've gone up 460, I've seen 410, recently 450. So it's, with the market conditions, the interest rates are kind of all over the place, but I can tell you it's your 2016 D, I believe, is producing the most savings at this time. So if we were to go to market, that's the one series that I can say it's good to go. The others we're still working and running the numbers and trying to figure, because what we've done is set a target, right? We don't just want to refund your bonds just to refund your bonds and to say we have a transaction. And so we've set certain targets, we've put certain targets in place. And these targets are, for example, we're looking at a 2.5% net present value savings. we don't hit that target, we're not going to go. We're waiting for this to make sense, so to speak, for us to move forward with the transaction.
And we're close to that?
We're close to that. That's exactly, which is why we, said, okay, let's look at the basket, the big picture, all 6 bonds, and then we will continue to monitor, see where we are. It may be only 20 million of the 55 that gives us, but at least we have the flexibility to be able to cherry pick, so to speak, and produce the savings that we're looking for the village.
Great. Thank you.
You're welcome.
Brian?
One of the things you mentioned is doing one bond issuance is cheaper, and that just made me think, given that we are talking about doing another bond issuance in the near future, does it make sense to do both the bond issuance for refunding and the bond issuance for capital projects as one bond, or is there a reason they have to be 2 separate bonds?
No, we can do them together. We don't have to do the refunding separately and the new money separately. We can certainly do that together. But again, a lot of what drives, how you proceed with the bond issue is not losing the opportunity that exists in the market because of interest rate movement, right? And timing for your new money. Okay. So those are things, you have to look at to determine if we want to move together or not. But we can certainly do that.
Yeah, so I guess I would flag that as I know we're going to be having a conversation in the near future about large capital expenditures that would be triggering the additional bond issuance, and it might be that making this decision about whether it makes sense to go forward with 1 bond issue or 2 bond issues it depends on sort of how quickly we're going to understand the scope of those capital needs to know how large that second bond would have to be, because certainly we want to move when the market conditions are appropriate so that we can get these savings. But if there's any kind of substantial savings in the costs of doing the bond issuance, since obviously it requires a lot of professional services, lawyers and others.
Well, the one thing we have to look at, if we decide to do the 2 together, when is the first payment due?
Right.
And so we don't want to not use the money, but we're paying interest on the money.
Right.
So we would have to take that as well into consideration. So how fast will you start to move so that you can start using the money that you're bonding?
Is there like the Oak Park streetscape, is that more predictable to consider incorporating, or that's still not going to be used until spring? I mean, how does...
No, that,
Okay.
That's a good one.
All right, so then potentially the ordinance might go to like 75,000 or 75 million to 80 million or something.
Mm-hmm.
So I mean, I certainly am in support of moving forward with refunding the past bond issue, refinancing in sort of more layman's terms, the past debt that's at a higher interest rate. I want us to be sort of thinking about how all these various pieces fit together, so we can issue as few bond series as possible to minimize those costs.
So would we would then have to change the ordinance?
We would need to. So the village would decide on how much new money And then we would just change the ordinance to reflect the refunding and new. And we will review the parameters that we've already set in the ordinance to make sure the new money piece is captured.
Yes, okay,
Yes.
okay.
All right, so then if I'm not, go ahead, John.
Is timing becoming, you mentioned the Fed quarterly determination with the interest rates. How much does that have to go into the timing issue? Is it more desirable to wait?
So, timing is key, right? Which is why we are proposing getting what's called a parameters ordinance in place. And what's a parameters ordinance? It's an ordinance that has certain terms that you agree on, meaning we're not going to move forward unless the interest, we get this much savings in dollars, not to exceed certain dollar amount in debt service and so forth. And once you have that in place, what that approved parameters ordinance does, it triggers for us to say, okay, it has already been authorized. So now we can go in the market when it's favorable.
So that does have effect.
That's right. That's right.
So likely we may wait until the next quarter's over with I don't know how the timing is going to be out of use of the money and so forth. But,
Exactly.
okay.
Exactly.
So if we were to add the potential to borrow to the ordinance, when would we have to have the ordinance done? Because we were doing tonight the 55, so I could put it on the agenda so we can start the process.
So bond counsel would just need to know when your deadline is to get the documents to your board. And so let's say it's Thursday of this week or tomorrow, they will put in those amendments and then we'll do a quick review and get that revised ordinance so you can get it over to your board.
So what I'm hearing then is that we would want to incorporate anything that's predictable in major new money.
Streetscape.
Largely the streetscape, yeah.
That bill won't come until a year from now, probably, right? So
Yeah,
that's what I think.
the
Donna's
first
saying.
payment, when we do it, it'll be like January, February. So the first interest payment would be due in November, December?
In November of next year, yes. And your Cook County, I believe it's February, like end of February for their levy cycle.
We
So
don't
as
know.
long as
That's what the library's doing.
as long as we issue and close the bonds, because bond counsel also needs to file with the clerk, right?
Mhm.
Documents need to be filed before, so that they can take effect.
Right.
Yes.
Is there a timing issue in terms of when the construction is going to start on whatever new capital improvements we might do and the issuance of the debt? You try to get those as close,
That's probably another issue.
so you don't have the sold the bonds in there where you're going to wait 6 months to start paying out on the project. Is there a timing effort there too?
So the new money portion
Start
has
project January.
3 years to spend down, right? Right down there. And I
Yeah.
don't know if you've spoken to bond counsel, but there is actually a spend down.
Yes.
formula.
I'm thinking about the upfront of that though. When do you start actually paying out from the bond issue for the construction of this project versus when you issued the debt?
So
I understand this question. So we say we were going to do the streetscape and we bombed the 20 million, we will get the 20 million and then we will start to pay as the bills come due. What I was mentioning is I don't think that it's prudent to borrow the 20 million and hold it for over a year.
Well, that's what I was saying. It's good.
So the streetscape is supposed to start next year. So the timing is okay for the 20 million because it will start next year.
Right.
So we won't be just paying interest on money that we're not using. It'll be used.
Okay.
Yeah. Because we wouldn't make our first payment till November.
All right.
Yeah. So the total amount then would be up to 75 million, 55 and then the 20 in the ordinance. Okay.
As long as that's fully inclusive of dollars and cents. I
Yes.
mean, like, it's not exactly 20.
Right.
Right. Okay. Yeah.
What we'll say is just up to.
Gotcha.
Yeah.
Very good. Yeah. Please.
Just one question. So the savings are $450 net. I'm just curious. What does the Spear get out of it? What are your fees?
Our fee? We have a contract in place.
Okay. Well, we can talk about it if you don't know.
Yeah, I can't recall, but we have a formula, and the formula is based on the par amount of the bonds. And so if 20 versus 50, then it changes based on the par.
Yeah.
Yes.
Okay, so that would be a change too. I was just curious about the existing proposal, but that's fine. We can get it later.
Yeah.
So, thank you.
I'm good with it. I'll just note to my colleagues that I know the savings doesn't come right away, but it is a magic number of $450,000, which is a number we're looking for later in this evening.
One number that we're looking
One
for.
number. I'm just saying. So, just an observation.
Very good.
That 450 is that across the entire span, or is it per year?
It's actually about 525 on over time, but net present value savings of about 450. We want more.
Yeah.
We're looking for more savings.
Same.
Okay. Well, we appreciate that. We do share your sentiment or goal there. Very good. So then I wonder, if you determine in the research of bringing that information to us, if on the agenda item, if we need to have both and, just in case the percentage of savings is questionable versus our decisiveness on the streetscape. But I think I'm hearing we're there.
Okay.
Mm-hmm. I would just leave you that for your own analysis.
Okay.
Based on what we don't know yet.
About the streetscape? Or?
No, just like if the savings starts to go down when you go to 75 million versus the 55 million, that you might want to know what we're saying. We might leave it to your judgment as to whether you want to put both ordinances on the agenda.
Okay.
Okay?
Okay, thank you.
Thank you.
Thank you. Don't we do?
All right, so now we have library, then living room, then CIP.
Correct.
So the library agenda item is item B, Oak Park Public Library operating budget request. Thank you for joining us.
Thank you for having me. I'm also a comment. I'm the executive director of the Oak Park Public Library.
I wonder if we need to move this a little closer to you.
Oh, the
The tape recorder, is that okay?
Yeah.
Yeah, thank you, Brian. Yeah. Maybe move the whole seat. Thank you, Brian.
All right. Thank you so much for your time tonight. I know we have a full agenda, so we're going to move quickly. The reason we're here is to talk about a bridge funding request. But before we get to that point, I think I want to share just a little bit of context about how we got here. So Oak Park Public Library we're a library for everyone. We have intentionally low barrier and inclusive service delivery. We're a village public library governed by an elected board of 7 trustees. We have about 130 employees across 3 locations with a 7-day-a-week operation, around 175 service hours per week. We are a high-use community resource, serving patrons of all ages. We welcome over 1,000 people a day in our physical locations and many more through our digital services. We budget in a way that's pretty traditional for a village public library. So our fiscal year 25 budget was about $12.5 million. 96% of that budget was funded by property taxes, and 75% of that budget was allocated for personnel costs. Again, these are very typical ratios for public libraries. Our fiscal year 25 expenditures are almost exactly on target for what we were expecting. While our expenditures are on track, our revenue is not on track. We are looking at a cash flow gap because of the delayed property tax disbursements. Because that timeline remains uncertain, this is causing quite a bit of concern on our side. We do not have the authority to levy or collect our own taxes. So any of the solutions that we're looking at require active village participation. We have a fund balance policy that is not designed for this kind of expected of long-term revenue delays. Our policy calls for a fund balance of between 40 and 48% of our general fund at the end of the fiscal year. Coming into this year, we exceeded that amount. So things are functioning as they should, but with this significant gap in revenue, we're facing a significant issue. This graph illustrates kind of how the system is supposed to work. You'll see that natural ebb and flow looking at last year's available cash by month. And then when you look at the trajectory of this year's, you can see sort of exactly where that issue of the delayed tax payment happened and where we're facing looking forward. We estimated the October numbers when we submitted this. We now have actual, which is about 3.9 million. So at the end of fiscal year 25, we are looking at projected cash holdings of just about $2 million. And without bridge funding, we could be looking at building closures and large-scale staff furloughs as early as January of 26. So we're here to make a request for $4.5 million in bridge funding. We're seeking a direct loan or a tax anticipation warrant to maintain uninterrupted service and operation if the disbursement continues past mid-December. If the disbursement happens before then, we do not need this bridge funding. But again, the timeline is undefined at this point. The idea would be that the repayment would happen upon receipt of the delayed property taxes. So we're not seeking long-term financial support with this. This would be truly a real bridge fund. So we get over that hump of delayed revenue. I know that this is bringing together a lot of different sort of systems at once, and would be happy to answer questions that folks have.
Okay, who'd like to start? Go for it.
Just to start with, how did you come up with $4.5 million? And just looking at the numbers, if you have $2 million at the end of the year, that'll carry you through February. So why do you say layoffs in January? I mean, is there some reason you have to keep a minimum balance, or because you'll still have enough money to go around? Hopefully, this gets resolved so people can pay their taxes before the end of the year. I know it'll take a month or so to get the money through the system into you.
And I think that's what we're imagining. It will take a little bit of time for the money to come to us. And if we were in a position where we knew that our cash holdings would be gone, we would be looking at both, terminating the staff costs, so going into the furloughs, which takes some time, and also then the ongoing building costs. So even if we closed the buildings and furloughed the staff, we would still need some available cash to keep those operational, so to keep the HVAC systems going and things like that.
I see. So it's a timing issue. And I personally think that they're going to resolve it quickly because county residents, if they do not pay pay their tax bill before the end of the year, their property tax bills, they won't get a deduction, and there'll be like a lot of problems associated with that when people can't take proper deductions in the proper year. It'll cause a lot. I can't imagine, and I'd like to know. I guess if anyone knows, I'd like to hear. I've heard nothing about like when this is expected to be resolved. So I do think it will be sooner rather than later. But have you heard anything? Does anyone know? You must be.
Well, we watched the tracker, the county tracker of sort of what tasks still need to be done before the disbursements can be made, but we don't have any inside information.
So last question, $4.5 million though. What's magic about that as opposed to 2 or 3 or 5, whatever?
I think the idea is that would get us sort of through April-ish, and it seems like a reasonable balance between thinking we have to go on forever without the tax revenue and imagining it'll be quick. So it felt like a reasonable.
I see. Okay.
Any other questions?
I got Donna. As far as $4.5 million, does the village have that sitting around? We have to, call and see early and get.
So we looked at a couple of different options. One is to, if the board decides to take out the tax anticipation warrant for the $4.5 million, that when the property tax money is received, it will go directly to pay the debt. So that the money could come to us, or it could go right away to pay the debt. The other option is that we pay out on an as-needed basis at a 4% interest rate, because that's what we get if we have to reduce any of our funding. We do at the 4%. Also, we would look at, and I have been working with Linda at the library on some information, and we're like doing a bunch of calculations, and we're still working. But we asked the same question, why 4.5%? 4.5 million, because based on when it would run out. And I see that I have the same question, that you have approximately $2 million in the bank and you're running $1 million. So then that means that you actually will run out of money in February.
Correct.
And then the other question was, if the money is advanced, what happens if the first payment next year is late? And so I have their budget, and they are budgeting a loss, which is their capital. Yeah. They budgeted a loss this year, which is capital, and then they budget a loss. The 2026 budget is at a $720,000 loss. And
I'm sorry, when you say loss,
meaning
less than the year before?
No, the expenditures are $720,000 more than revenue they're bringing in. So that was concerning. And also, which I just found out today, the library, because they don't levy for themselves, are only allowed to levy CPI or up to 5%, whichever is less. CPI is 2.9%. So that means that the village, because we're home rule, we can then say we can levy, because they're levying 5% for next year. But based on the law, they are only allowed to levy 2.9. But because the village is home rule, we can allow on their levy for it to go up to 5. Now, that was explained to me today. So we're looking at a few variables.
Libraries, yeah, that was, we did get an opinion from legal counsel on that. That is the PTEL law and the tax caps related to it. And so the library, as far as the advice we got, would be subject to that. They're classified as a local library and not a library district, subject to the village's levy. And so the tax caps are CPI or 5%, whichever is less. And CPI is 2.9.
2.9.
So any additional levy beyond the cap that's allowed would be the village's levy to support.
What was their levy last year?
They levied, what, 11.4? It was less. I don't have that one right here. And this year they're levying 11.9. And even though they're levying 11.9, the concern is they are doing the levy at 11.9 is that they're budgeting at a loss. So when you look at their revenue, their levy, and you look at the revenue just on the operating side, they balance. Yes, they balance. But it's the loss. How are you going to pay for the loss? Because when we looked at the one account that they are receiving money in, they have been drawing down on that account. And that probably is, if I'm not mistaken, where the $2 million is, the one that's being drawn down.
Yeah, $2 million is over a few different accounts.
Yeah.
Is this going to require a change in how you budget, or does your board discuss that?
So we're talking about whether the fund balance policy needs to change. The fund balance policy has worked really well up until this year. I think there was 1 year in the 90s where there was an issue with available funds. So without knowing what the future of tax revenue will look like, it's hard to answer that. If we were to build up higher cash reserves, I think that's something that needs to be handled really strategically, because holding too much of a reserve as a public library is also questionable stewardship. So I think it's finding the sweet spot, kind of not knowing what the tax revenue timeline might be moving forward. So if this is an anomaly, this late payment, I think that the history of our organization's budget looks like what we're doing is going to work. If this is not an anomaly and it's a repeated pattern, then we would need to change the reserve ratios. The question then is, how do you do that? So to do that, we would probably look to levy higher so that we could put money into reserve funds to use in future years. And that's not an ideal situation.
Brian?
What was your reserve ratio at the under the I guess what was your anticipated reserve ratio at the end of 2025 before the budgeted $720,000 shortfall for 2026?
54%.
Okay, so and after $720,000 deficit for 2026, what would you anticipate your reserve ratio to be?
I don't have that calculation.
Okay,
but it would be within the range of our fund balance.
Right. So the fund balance policy you said was 40 to 49%.
Between 40 and 48.
40 and 48. So you had a fund balance that exceeded your fund balance policy, and so you're budgeting around trying to bring your fund balance back in line with your fund balance policy, and that's the reason for the deficit based on capital expenditures.
I think that's fair, yes.
Okay. So, I mean, I think that I certainly understand a lot of the questions we have. I guess one of I don't know. I know that in the past we got guidance from legal on like the library gets to set their budget and it gets incorporated into. I understand, here because they're asking for a loan. It may feel like we have leverage to ask the library to do something, but the library gets to set their budget. They have a duly elected board that is working within their authority to set a budget and working to be good stewards of our community's resources based on what they understand that the community to be directing them to do. So I personally, I have a hard time not having stood in those shoes and been in all of the meetings where all the nuances of these budget conversations were had, saying that, oh, the library should be cutting their budget here or there, or I appreciate sort of the thoughtful line of questioning, but at the same time, I also want to defer to my colleagues on the library board, who I have no doubt have been thinking very hard about what the residents have asked them to do. I think on the question before us of the bridge loan for what was the tax anticipation warrant.
Right.
I think that we want our library to stay open, particularly during the winter months. I imagine your utilization of services is probably goes up in the winter months. People are less likely to go to parks and more likely to go to the library.
Some services, yes.
So I think it's vital that we that we provide the resources, knowing that this is truly a question of when we get around to being allowed to pay our taxes as residents. I never thought I'd have to wait on the government to ask me for my money, but here we are. When we get around to being allowed to pay our taxes, the money will come back to us. I don't know the sort of the nuances of how it sounds like you're working on how to negotiate what the terms of such a loan would be, and I think that's reasonable, and I need you to work with staff on that. But I do think it's vital that we figure out how to keep our library open pending Cook County letting us pay our taxes.
Yeah, I don't know that I'm hearing
Yeah, I agree
anyone
with that.
disagree. Yeah,
Yeah.
for processing
How much?
for a second. But are there anything about the terms that cause pause for the library?
I mean, we would always prefer lower interest to higher interest. And some of this that we're not hearing right now is the first time I'm hearing the numbers. But no, I would say that the terms I'm hearing right now, we could figure out.
What if you find that you end up not needing it? I mean, how? And then, I mean, certainly don't want to see a partner governmental body pay interest that they don't need. I think this is the first time that we're hearing some of this deep level of detail too, and it's based on like what we heard is based on the interest we would usually get from the dollars. So, what if you don't need it?
So if the timing worked out that we went forward with like the TAW, and then there was an overlap of that funding, I mean that's not great stewardship, but I think it's better stewardship to pay interest on a very short-term loan than it is to close the library or to go into we've got 48 hours for the check to come in, and it's going to be too close. So I think that that's a risk that we may just have to deal with. And I don't know, Donna, you may know, what the timeline is. So if we went forward with a TAW, what is the process from that decision being made to the money becoming available?
Roughly, yeah.
So when we issue tax anticipation notes or warrants as a short-term note, as a short-term financing, we typically look at when you need the money. So we use the need timeline to determine if it's a 3-month or if it's a 6-month note, right? And then we look at numbers to determine how much that is, and we recommend, sometimes it may be the case, or it depends on the route you want to take. You may already have a relationship with a local bank. We can work with them, or we can also go out and get bids from several banks on the interest rates, and the best bid win, which is the lowest interest rate. And then we would structure the payment for you, and we have a closing where you will now get the funds to take care of your expenses, and then we can set up with Cook County to have those funds either go to an escrow account, which is a formal setup once the monies are collected, or we can have, and this I actually found out from Bond Council recently, where the village can provide Cook County your account, and they can sweep the funds there as well. So we have options for how the funds can be collected.
Can we not have the funds? Greg was asking, I'm sorry, Brian, you might be able to word this better than I anyway, but Greg was asking, do we not have the funds like readily available, right? Did you get
Yeah, so like in 97, they have money in their fund balance, but they have like 6-month CDs that if they break them, they're going to charge a fee. So that's what I was trying to get at with the village.
Oh, no, we
have 4.5 just sitting in cash that's not going to be taking an expense on our end. Like we have to cut a 6-month CD early.
No, we don't have to. We don't have to cut a CD. So first of all, I want to make sure you understand. I'm not saying to close the library. I'm not saying that at all. What I'm giving is options to the board to say you can do something monthly at 4% interest. And I'm not sure. I do know it was mentioned at 4% interest because that's what we would be getting on our money if it was still sitting in the bank. You also have the option of taking a lower tax anticipation warrant or taking the 4.5. You could do a combination. If you need the money in January, you take what you need, like $1 million to get you through January, and hopefully it will come in February. But it's giving you options. Nobody's talking about close or lay people off. It's just that what is the best route to take? I did say on the call, and John was on the call, my biggest concern is what happens if the first payment in 2026 is late. Because the money coming in will be going back to pay the tax anticipation warrant.
So with our current structure, we would most likely be seeking additional funding if the next, would you agree with that?
I agree. It would be 96% funded by property tax dollars. What are our options?
Right.
Go ahead,
Is the
John.
only option we're looking at is tax anticipation warrants, or is one option that the village could literally loan them the money of our current funding and then they pay us back?
Mm-hmm.
It'd save the cost of issuing tax anticipation warrants and all of that.
Right.
And then we can also time it as to, well, when you need $1 million, give us a call, whatever it's going to be.
Right. No, it was mentioned tax anticipation warrants. The very first time we talked about it was a much lower amount, and that could have been very easily from the fund balance. But then it went to 4.5 million, so it was tax anticipation warrants.
Okay.
That was brought to us.
Okay.
Yes.
But would you entertain, or would we entertain the possibility of loaning them the money out of our reserve funds until they?
Yeah, okay. That's up to you.
Yeah, I mean, I
Some
would
people
want
don't,
whatever is
yeah.
the cheapest route for the library.
Mhm.
You
Well, that would
know,
go ahead.
and
Sounds like that might be it, right?
I mean, yeah. I wonder why we would do anything else.
I mean, we may not need it, it's just that we don't know.
Yeah.
And to that point, I mean, we're talking about a number, $4.5 million, but is it possible to do it more as structure it more like a line of credit, where it's you have a line of credit of $4.5 million, but you take what you need when you need it, because if it's just January and then the taxes come in, then you only end up needing $1 million, and there's no reason for you to be paying interest on $4.5 million. So I think it makes sense to structure this as more of a line of credit, and that way we can keep the costs down to just the money that the library actually needs to keep operations open while we're waiting for Cook County to let us pay our taxes.
And how does that work for you? I mean, when you asked for 4.5, was there a reason that would differ from the benefit of a line of credit?
No, I think the line of credit would be great. I didn't know what the full options were, and I'm hearing more about them now, which is great. I think the way we budget, we would be able to give pretty specific asks with pretty specific dates. So I think the line of credit would meet our needs effectively.
And does our staff feel like there's any kind of burden on that we don't understand right now?
I don't think so.
Then
Yeah, it has to be within a legal
Yes,
document.
it does.
Yeah.
is there anything about levying over 2.9 that is a public notice on our that we're required to do or no?
No, I levy on the public notice. I put it at 5.
Right, but that's our levy.
That's correct.
Which library
No, the
is
library is on there.
incorporated into, but there's no notice to the community otherwise specific to the two separation.
Yeah, on the I believe on the public notice it said it gives the library's amount at 5%, and then it gives ours amount at 4.96. I have to look at it,
So
but
far.
the library is. Yes.
Okay.
Yeah.
All right. Well, yeah, I imagine this has been quite stressful for you, and I don't think that was anyone's intention that I'm hearing of. It's just, this is strange for all of us. Greg, anything further?
I just will make note that the struggle you talked about, 97 looked to borrowing 21 from 200, and this whole thing they just said it wasn't worth $30,000 in savings a month to go to 200, so they just did tax anticipation warrants. So just to know, it's not your own struggle. And just last night, 97, they already have their boards already approved $12.5 million tax anticipation warrants. So you're not the only district or government body here in Oak Park that's they're all just these two, just library and 97. 200 is close.
Do you know what kind of interest you usually make on your money?
Yes.
Most of our funds sit in the Illinois funds account, and it usually I think it's been averaging around 4%, 4.1, and going down.
So the question is, I don't want to be a rain on the parade, but I will say, looking at these numbers, you're budgeting for break even, and then your capital comes off after, and it's your budget for a loss every year. Your fund balance just isn't enough, and I'm not suggesting, I don't know what I'm suggesting, but I will say that you're going to lose a lot of your interest income this year because you're drawing down these funds. You had $288,000 of interest income because it earned 4%, as was just mentioned, and that was on a balance of about $7 million. So you're going to be pinched there, and that's going to be difficult. And you're budgeting for a loss, and that comes out of the if you realize a break even on your operating and your capital comes out afterwards, then you're going to deplete your fund balance even more. And if you have any sort of a delay, you're going to be right back and asking for more because it's going to be a continuing issue. So you've got to, I don't want to say because I'm not an expert, but it looked like a structural type situation there where you're clipping along at a fairly aggressive rate in terms of spend, and this could happen again. And again, you're going to lose a lot of your interest income next year, or this year. It's going to be much, much lower. So just be aware, there's a lot of moving pieces here, again, as always in all these budgets.
Yeah, I mean, like I mentioned before, there was one year in the 90s that the library did pursue a loan through the village. So it's not the first time, but it's been a long time that the budget has worked. Like all other organizations, we're also really struggling with inflation and all of those pieces that are affecting all of us. So, but I appreciate the comments.
Thank you.
Yeah, the loan in the 90s was $200,000.
It was a different time.
All right, so go ahead, Martin.
Yeah, I support this. Sucks that you guys are in this spot. A question about the levy aspect of this, a 2.9, 3.15 total, public notice, all of that. That's a little new to me. How does that work exactly? Because I'm aware that we've always levied on behalf of the library. I'm not aware that we're responsibly taking, authority for levying on behalf of the library. I mean, the way I just heard it seems to me like the library is like we're taking responsibility for their levy.
No.
So is it like we can tell them, oh no, that's too much, or
No.
Okay.
No, I did subject to the law, the legal limit.
Okay.
So if the legal limit is CPI, the less CPI or 5%, CPI is 2.9%. The law says you can't levy more than 2.9%. So if they say to the village board they want to levy 6%, we should just know that they're limited at 2.9%, and any additional levy over 2.9% would be absorbed by the village.
Got it. What does that mean, absorbed by the village?
We would be contributing to their levy.
Okay. So then we would increase our levy in order to make up the shortfall for them.
Correct.
Okay.
How much is that?
We would
increase ours. We would leave it on theirs. You just have to know, because I did ask that question just a few minutes ago. So the it's like what 2.9, 2.1, the difference. So it's 2.1%. So the levy will still be for the village 4.96, and the library would be 5. But I was told that I had to make you all aware that the library had it was 2.9, the lesser of 2.9 or 5%.
Right.
Yeah.
The P-Zone thing, I get that. And
so who covers the additional levy for the library?
Well, the library will get the money, but we're responsible.
Well, what does it cost? I mean,
it is a cost.
What is it? I mean, I'd like to, when we talk about it, it needs to be discussed at some, not now.
Oh, yeah.
I mean,
Oh, absolutely. I think, the stream of communication on this, we haven't had a lot of communication with the library. We just started to get more communication recently in an effort to try to get here quickly. So we had potentially gotten what we needed in order to have this discussion. Certainly, I started working with the attorney to ask questions. One of the questions I asked was about the classification of the library. Is it the local library, library district? What are their authorities? And so forth. And so I got some advice today. So this is hot. This is new. I worked with Donna to inform her, to have some follow-up questions with legal counsel. So I think this is just a question that we're trying to create awareness around, and we will actually provide some follow-up information. So this is as much as we have today. We just want to make you aware that they are subject to PTEL. And if it becomes an issue where the library is requesting additional levy over the amount that they're allowed to levy, then we need to get direction from you on whether or not you support that.
Yeah, and then so this is like the first time I'm hearing that, right? Because I think the library's levy has been over PTEL every year that I've been on the board, and we've had that conversation. And still, that's where like a lot of the conversations, a lot of the questions are coming from, just trying to understand the machinery of how this is working, because my understanding was that the library levies and they just piggyback on our paper, right? But we don't really have any responsibility for it, aside from the fact that we're just collecting on your behalf, right? And it sounds like it's still that way, but it's also kind of a cheat code that the library gets that the other PTEL bodies don't get, which is fine. I don't really care. That's the library's board to deal with your constituents and however you levy. Just trying to understand like how we fit into this and how I need to communicate to my constituents on the levy that comes through. And like, because once, I don't think many people know that the library is subject to PTEL outside of this room now, right? And so once that becomes common knowledge, I'm going to get a lot of questions on. So why is the village allowing the library to levy 8% last year, or 6% the year before, whatever it was, and 5% this year? I just want to know how to answer those questions, so that because I don't think it's our responsibility, and I just want to, when I say that, I just want to make sure that's the truth.
Yes, absolutely, and so completely understand that, and so we will be following up with some written communication. Spend a little bit more time with the village attorney, provide that written communication to clarify that.
Awesome.
So that you guys have that information. Great.
Perfect.
Yep.
Thank you. And like I said, get completely supportive of this. Whatever way we need to do it to make it most reasonable makes sense to me.
So I would be looking to put it on the 11/18 agenda, because I can't get it through legal back quicker than that. And then working with the library. When's your next board meeting?
November 18th.
Oh, the same time? Okay.
And then if it proceeds on the 18th, then how quickly can things be set up so they can have access to funds? Do you have a sense of that?
Oh, very quickly. We're giving it.
Okay.
Yeah.
Great. And that works for you all? Time-wise, yeah.
I think I'm struggling with the word responsible. I mean, like saying we're responsible for it. There's, as to Brian's point, there's a duly elected board. They're responsible for it. We are the means by which they're communicating it to their constituents. I mean, we don't really have the authority to say no.
No, we don't.
So then I don't like the word responsible.
But I think allow us a day or so to produce a legal interpretation of the law and how the tax cap applies to the library. And so, but just theoretically, not theoretically, actually, if they're subject to a cap, should they be levying more than a cap? Just start there.
Well, I get it, but it's not for us to say that, though. I mean, it's for the taxpayer to say that.
Is it for us to say? I don't think so. It never has been.
It might be for us to say if we're actually subsidizing any amount over the cap. You might have some choice in whether or not you want to do that. So we'll clarify that, whether or not we're adding to the library's levy on top of what they can levy. We're levying an additional amount to support the library operations.
Got it.
That's the question I think we need to talk about.
Yeah, I mean, because an hour ago I thought they were basically inherited our home rule of their authority to set their levy or whatever they wanted.
Say that one more time.
That was my understanding for the last 3 years I've been on the board. Is that they inherit our home rule authority, and it just basically passes through our paper.
So this is my first budget cycle as a director here. I was a director of a different state before. What information would be helpful from the library as you have these continuing conversations?
It's a good question. I'll be honest, like from my perspective, I don't know, right? Because all this is brand new to me. So I wouldn't have even thought to think that you all were, beholden to PTEL before an hour ago.
The libraries in Illinois, I think there's 3 different ways you can be organized. One is the way they are here, separate government, but through the village. And then you could be a separate district altogether, like the Park District, and then you could be a department of the village.
That's correct. That's all.
So they're kind of in the middle. Over the years, it's tended to work pretty well. There may have been some rubbing up against each other once in a while. But I think what we've kind of come to tonight is probably a pretty good solution. Helping them out and making it as inexpensive for the local taxpayer who pays taxes to all of us. And getting it done that way.
Yeah, absolutely agree. Right, I do think this, is the best possible solution. Just new information that I didn't have. Right, I mean, the library's levy is between the library and its constituents, right? Like, I don't care. I just want to know what I need to know to talk to my constituents about it if I get asked. I know I do have a group of folks who have asked me over the years, why are you guys allowing the library? And I had to say, whoa, we don't allow. The library submits their budget to us, and then we go and get the money, right? And so, but this will cause those questions to come up again.
And since Donna and we met first at the end of September to kind of start these conversations, and I feel like there's been a lot of learning about each other and how, like, what the interplay is, and as being new in this position and having a majority new board of trustees, it's been really great to have these questions and to learn more and to share history. The library has a huge advantage when we're talking about finances in being a public agency. So we publish our expenditures every month, and we have a great wealth of easily accessible financial information, kind of going back as far as you'd like to go. And we're more than happy to pull that, however it would be helpful.
Yeah, and I've looked through it before. It is great. You guys do publish a great wealth of information.
And we also have a finance committee on the board, and I know that the finance committee in the library would be happy to meet with this entity, or however that might need to look as well.
Yeah. No, just for intergovernmental cooperation, it's great. I don't really have, like I said, I don't really have concerns about, what amount of money you guys get and how you spend it, right? It's between you and constituents. Just trying to figure out like what our role here is in it, so I know how to communicate it to the community when I get asked.
Okay. Then what I heard was potentially the kind of line of credit type of might be the one to research, but overall the board is, or the finance committee, I'm hearing no objection to doing whatever is necessary to work with the library to keep their funds flowing. No interest in charging the taxpayer more than necessary. I mean, for me, the last 15 minutes hasn't been any objection to that. It's only been processing this new information because I've sat here and asked this question, not here right now, but in this committee, but I've asked this question in the past, meaning the previous administration. So it did change from what we were told previously. Okay.
I was worth asking for specific. If you need information from them, and if you would like to tell them if there's things you need, the village wants to get more financial data or information as time goes on.
Yes, I actually have a very good working relationship with Linda.
Good.
At the library. So anytime I need any information, she sends it over. Yeah. And I know that she checks with staff, with her bosses to say she's looking for this. But yeah, she's been very receptive. I've been able to get whatever I need.
Great. Thank you.
Okay. Thank you.
Thank you.
Oh, thank you.
So next on the agenda, we have a discussion regarding the request from the living room for $150,000 a year for 3 years. That was thrown from the village board to this committee to discuss further and identify a revenue source or what that arrangement might look like. Correct?
That's correct.
Who's here?
I think, so is this the This
Oh,
is the
okay,
same.
this is just for our reference.
Yes,
We're
this
not
is just for
asking
your reference.
Yeah.
This is the presentation that was delivered to the village board just
Yeah.
a week ago, 2 weeks ago.
Yeah.
So I think the task for the finance committee is to have further discussion about potentially identifying a way to fund the proposal. And we have staff here to support the finance committee discussion on the Living Project itself, the police, fire, and neighborhood services. In the agenda item commentary, under the recommended action, if the board decides that it wants to, or the finance committee decides it wants to recommend funding, staff has some recommendations here about parameters for that funding. And I think, Donna, from a financial standpoint, in terms of how to fund it, the recommendation would be to
Add it to the levy.
add it to the levy.
Okay, so that would be the step. Can we back up for just a second? I want to make sure that our advisory committee members who are not participating in the board meeting, if they know what we're looking at right now.
Very sketchy.
First, okay. So, and Cheryl, if you decide you want to help me with this, please do. But we've got two members, advisory board members who are not part of the board who, so there was a presentation to the village board to support Old Living Room.
I think,
Yeah, maybe.
We'll have Cheryl Potts.
Yeah, do you mind, Cheryl?
No. We'll ask her to just give a
Very
overview.
brief.
I'll keep it very quick.
Because I do want the full participation from any of the finance committee member questioning.
Of course, yes. So very quickly,
And you are?
I'm sorry. I'm Cheryl Potts. I'm with the Community Mental Health Board of Oak Park Township. So I know Greg from our finance committee in the township. We brought a proposal forward that we are working with NAMI Metro Suburban with the hopes to open a living room program here in Oak Park. The purpose of a living room program is to be a diversion from 911 and hospital inpatient ER visits for people who are experiencing a mental health crisis. It's a national model, so there's a lot of evidence-based research behind it that shows its effectiveness at reducing emergency department visits and reducing reliance on specifically ambulance, but 911 overall. This was a project that was noted by the village's Alternative Calls Task Force for mental health crisis as one of the solutions that could be one of the recommendations that came forward. And it was also noted in the village's health department's I-Plan, the last cycle, as a recommendation to review. So this is, you'll see here that we are looking at an annual operating budget of about $350,000 per year. The reason why we want to do a 3-year project is for it to be a pilot project only, because our intent is to gather the requisite data that would allow us to apply to the state of Illinois for continued funding if the living room program is needed and is showing a good impact. If it's not shown to be needed or is not shown to have an impact, then we discontinue after the 3-year pilot project. But either way, there is an off-ramp for all funders involved. This would be a shared expense across the village. So the Community Mental Health Board of Oak Park Township, as well as the Township General Fund, would be contributing $110,000 per year for operations, as well as all of the capital improvement, $85,000 there. There are other funders at the table as well, including Rush Oak Park Hospital, the Oak Park River Forest Community Foundation, River Forest Township, and then there is an ask out to Forest Park, the Village of Forest Park as well. And we are I want to also say that we are continuing to look for other funders as well, with the expectation that any additional money we are able to bring to the table would be a reduction on what we would be requesting from the village. So the $150,000 per year would be the cap, and it could be less than that if we're able to secure more funding. And I think that's it. I tried to keep it very short, but I might have missed some details, and I'm happy to answer questions.
John, Craig, any questions?
Yeah. So what happens in the living room?
Thank you. Yes.
Can we go to the one with the breakdown of the page with the breakdown of the different contributions? There we go. Thank you.
So at a living room program, what it is we're looking to have it be a street front space that's next to NAMI Metro Suburban's drop-in center right now, which is over on Harrison. It is a very sensory appropriate building that would allow people who are experiencing mental health crisis to walk in and immediately see mental health clinicians.
So it's a drop-in center?
No, it's different from a drop-in center because the drop-in center is not staffed by clinicians. The living room program is. And so the living room program has the staff who are the clinicians who are trained to do the assessment and de-escalation, and it's more for an acute state as opposed to the drop-in center, which is more for social, recreational, peer activities. This is more for someone who is truly experiencing a crisis. And then they receive an immediate assessment to determine are they immediately at harm to themselves or others. If so, then you do have to involve the hospital system, or can they stay in that site and be de-escalated and surrounded with support services. The other piece of the living room program is the follow-up that occurs. So if someone goes to a hospital, they're just discharged and they're left to their own devices. The living room does consistent follow-up, often up to 30 or 60 days after being at the living room program.
How many hours of operation would that entail?
So right now what we're looking at would be 8 hours of operation a day. So it would be from, I think the hours were noon to 8 p.m. NAMI Metro Suburban operates 2 living room programs right now, one in Summit and one in LaGrange, that are 24/7. And because they're funded by the state of Illinois and the state requires they be 24/7, but where they are seeing the most utilization is from the hours of noon to 8, which is why we chose those hours. And it would be 365 days a year.
And it would be anybody who drops in?
Anybody who drops in. And
Doesn't have
it's
to live in Oak Park or River Forest or Forest Park? Berkeley?
correct.
Okay.
Correct.
Great. That's...
Yeah, and the other thing I wanted to point out is the reason why we're seeing a need for this is neither Rush Oak Park nor West Suburban have psychiatric beds. So, and right now, if someone calls 911, by state law, the ambulances do need to take someone to the closest hospital, and so they will end up at Rush or West Suburban, and will have to sit in the emergency department until they're transferred to a psychiatric bed, which would be River Edge, Madden, or other hospitals. What NAMI Metro Suburban does if someone needs hospitalization, which is a very low percentage, I think they it's been like 6% of who they've seen over the years have required hospitalization. Though that 6%, they're able to take that person, physically take that person to River Edge or to Madden and bypass the whole need for one. It reduces the strain on ambulances because they're not calling 911. It reduces strains on the hospitals because they're not taking up emergency department beds, and they're getting that hand-holding to get to the right place immediately as opposed to having to wait days to get there.
Thank you.
You're welcome.
Okay, before we continue, is there anything that our staff wanted to add to it, whether Jonathan, or just to make sure that you feel like you have the opportunity to chief or the fire chief? You don't have to, I just want to make sure you feel welcome to.
Yeah, I don't know from a neighborhood services standpoint that we have more that we necessarily add. I know in the follow-up we had conversations with Cheryl about the funding in particular. The idea, and you'll see this in the NAC that was prepared for this, talking through the idea of having them come back, report back to the board on the progress that's being made, as well as the ability to find additional funding sources in out years and the impact that that would have on funding programs. And subsequent years, like Cheryl mentioned, we did talk in there as well about staffing impacts and sort of uncertainty related to that, because of uncertainty about how transportation would happen to and from the living room. And so we can't say for certain exactly what its impact would be one way or the other on emergency service costs for the village at this time, but we'll reveal more through the process of the plan.
Right, that would be part of the measures, the metrics that we would capture.
Right, and as was noted, anyone can drop in, so anyone can drive themselves.
Correct. Anyone can drive themselves, and also there is a part of the budget that NAMI utilizes where they will pay for Ubers to the living room program, because sometimes people who are in an acute state of crisis or shouldn't be driving or taking public transportation. And again, they will also transport the person to a hospital if that is necessary.
Anything from either of our chiefs? Again, you don't have to. I just want to make sure you feel welcome.
Thank you.
Mm-hmm. Okay. Any questions, John or Greg?
Well, I just noticed that Oak Park's got a big chunk to
Yes. I mean, but, you know, with your experience in the community, you are aware that the Community Mental Health Board is under the township budget, right? And and I think as Jonathan was saying, if we move forward, if there's opportunity for some additional contributions elsewhere, our amount is the one that we could have.
No, it just happens a lot.
Can't say that we don't, feel that also. There's what I heard from my colleagues, and they can jump in at the board table, is there's a lot of synergy between this and our investment in alternative response, our investment in we have our ECHO program, engaging community for healthy outcomes. Hoping to see potentially a reduction, but I'm not the expert on this, in fire and police calls if people are receiving that follow-up care. Also, just for people that might not be in our data collection at all right now because they're not seeking care. Jim? Now I think we probably should be getting into the budget conversation.
And now you know where you guys know where I stand, and I think I can hear the way the direction is moving here. I want to just caution that we're looking at our own budget with a 5% increase. We're talking about taking on various projects already. The Park Avenue Streetscape Bond. We're looking at the police station. We're looking at major projects throughout the village, like I've never seen in one hitting in this particular year. We're looking at spending down our fund balance by $17 million right now. This is the proposal. $17 million spend down. This is on top of all that. This is going to raise our levy. Well, it's going to raise it by what, half a point or something like that. And I was a member of the Mental Health Board, liaison member from the township, because I was on there for years, and I was a member of the township for 6 years. So I'm really plugged into this, and I believe that this is a good program. I don't believe we're fiduciaries of this body, and there is another body that is designated with the sole purpose of providing social services to residents and the CMHB is plugged into that as a 702 board that were designed 50 years ago. It was aligned with the township because the missions are in alignment totally. And the township has a fund balance of $2.7 million currently, which a big chunk of it is undesignated. And if I were on the township board right now, I would be advocating to pay for this. And if there was another body that didn't think maybe they should, it's in their purview at the moment, or they think it's scope creep, maybe a couple members do, that I would be stepping up and saying, you know, this is the time, this is why we're here, this is why this board was created, what it's for, this is why, this is what we're supposed to do. And not come to the village and ask for another taxing body to come and pay 15 times the amount of the one that really is most appropriately designed to handle this. So that's all I'm saying. And if this is the will of the board, and I always say that, if it's the will of the board, and it means but I don't advise it. I don't, as a fiduciary, it's just not what we should be doing. I hear what you're all thinking and saying. Are there other ways? Here's the thing. I'll just say one other thing. We're going to have to tax for this. And right now, we're going to have to actually go out and collect tax from residents, and it's an additional amount. And Donna knows this, it's $150,000 a year. Here's the thing. The township has already taxed, and they have money sitting there. We want to be efficient. We talk about collaboration. The best thing that could happen here is for them to come up with the money out of their, and I'm not going to speak for them because I don't want to, I'm just saying as an outsider, the best thing is for a body like that has already taxed the public for these benefits, for this purpose, just writes the check. Now come to us and we have to tax again. We're double taxation here for what? And it's just not necessary. So that's all I'm saying. If you decide to do it, I'll honor that. And I will go with the will of the board. I wouldn't advise it. It's like it's fiduciaries of this, and it unfortunately it's of what we handle here. It's designed to have certain blinders for us to be focused on our operations and our people and our mission. This just falls outside. I do support it. I think it's worthy, but I just think that there are other ways this could go forward and everyone can be happy. And I haven't heard or seen one iota of that from any other taxing body. So. And I don't know if they've ever, in other taxing bodies, have been approached to say, oh, you want to come up with $10,000, we really need $80,000, or some other amount. I don't know why it's like the lock is on the treasury there. But that's their decision, and you have to abide by that if that is the decision. So I'll be open to comment. I'm done.
Cheryl, was this chart created by your board or?
I don't understand the question.
And I mean, like deciding how much to ask each of the governmental bodies. Was that a discussion at your board table?
We brought all of the partners together back in January. We brought all of we invited the village. The village wasn't able to attend that meeting, but all of the other partners came together at that time. And we're looking at the budgets. I know just from, again, I don't speak on behalf of the trustees of the township. I can just say from a fly on the wall, $2.7 million is the fund balance. That is 5 months operating expenses. We understand that we're in different times right now. There are lots of concerns about potential the federal and state cuts coming down to senior services that we need to prop up. There are some concerns with the Youth and Family Services and the General Assistance Program. And so right now, the 5 months operating is within our fund balance. And so I don't want it to seem like we're sitting on money that's not being allocated. It is very thoughtfully being allocated by the trustees. I will say also that we are coming to the table with $110,000 a year coming from the township, and there's nothing that says that we can't look at after getting through this year, if there's additional money that the township would be able to kick in for that. And again, we are asking others that we've been working 3 years on this project, and it would have been the easiest. It would have been much easier for me to just unilaterally say the Community Mental Health Board is doing this on our own, or the township's doing this on our own. So we would have done that if we could, and I'm just being very honest and transparent that's not within our capabilities right now.
Appreciate that. Thank you. And one last question, Cheryl. If you're not able to secure funds from the Forest Park or from the Rush Oak Park Hospital, have there been discussions as to how to handle that?
Yeah, we are very, very close to having the Rush Oak Park committed, but I'm not going to speak for Dr. Romero, but just in my conversations, we're feeling pretty optimistic about that. If the funding from the Village of Forest Park doesn't come through, or if there are additional expenses that arise from NAMI, then we are looking within the CMHB's fund balance of trying to absorb those funds, that expense. So again, $150 to the Village of Oak Park would be the cap, not the floor. And also I know that we don't have the data yet, but if we look at the other living room programs, municipalities have benefited directly from these programs when it comes to fire and EMS specifically. So that is also, we would hope that that the village would see that it is a benefit to you, because this came up through the Alternative Calls Task Force, which was a village endeavor. So I don't. This isn't just a purely social service. This is why we're trying to bring funding together for this, to see this as a community effort.
Thank you. Village Manager Jackson, was the $250,000 in the alternative response that was set aside years ago, does that still exist?
$250,000 for the alternative call response? You mean a different phase?
We committed it years ago, but we kind of advanced it. Is that being used at this time?
Well, we have not. We necessarily identified it as a potential source from fund balance on a one-time basis to support a second phase. I think at this point, you see it's in the fund balance right now. Whether or not the village board is still committed to using it in the context of all the other financial considerations that are before the trustees at this time, there'll be an opportunity to discuss that second phase at some point, and whether or not the village resources can support it, whether it's through the fund balance or additional levy. So we do anticipate at some point having a conversation about the second phase, but that $250,000 is really just, it's in the fund balance, essentially.
Do you know what the hopeful timing there might be, or if that's not something you can answer right now? I'm not trying to press it, because I do think there is commitment. I've heard it previously to want to continue that conversation.
I would say first quarter of 26. I think we do want to re-engage with the alternative calls for service task force to kind of get an updated perspective on where the CESA law is and implementation and so forth, so that we have a better understanding of whether or not there's an opportunity to enable the dispatch function that was not previously a consideration because of the delay in implementation of CESA. But apparently there's been some updated information in terms of pilots that are being implemented throughout the state to allow 911 to dispatch to 988. So I think we need to have some conversations around what what that updated perspective means, and if there are opportunities for us to potentially implement the second phase as conceived, where there would be a dispatch. At the time we were talking about the potential second phase, the village was the only institution that could actually dispatch to those calls. So I would say it's very likely we may touch base with the task force sometime into late December prior to the holidays, or if we're not able to do it then, certainly in January, and we'll have an updated perspective on where we're headed with the second phase. Even so, there will need to be a discussion about how do you finance it, how do you fund it, and then the current phase is still only funded on a one-time basis. It's not structurally funded. So there's still going to need to be some discussion about how you continue to support the first phase. So you get the first phase that's temporarily funded, and then there's the consideration for the second phase that we will be talking about in 2026. But then there's the overall decision around how do you support these a first phase and a second phase structurally into the future, or do. So.
Yeah.
So all of this is temporary. The first phase is temporarily funded. The second phase is subject to the village board's review and whether or not you want to allocate one-time funding from the fund balance to support it, like you did with the first phase, or do you want to make the commitment to fund it all structurally?
Okay, so John, I'm going to add one more thing from the board meeting. The 150 for 3 years is a pilot. There's a strict commitment that was also shared by the Community Mental Health Board that if state funding is not secured, then it won't go forward.
Because this is $150,000 each year for 3 years.
Each year for 3 years, and so, but it's 3 years of funding is the only thing that we're committing to. You know, from your experience at the board table, sometimes that feels like you're committing to much more than that, but there is a strict commitment that if we can't get state funding, it's not something that it would have to be a separate decision for our committee to decide to continue to invest. We heard at the board table that the board was largely supportive of this. That was what we heard from our colleagues that day. It was tossed to this committee. So we probably should kind of shift that funding to the how to pay for it, but I do think this was still helpful, maybe in helping us guide us in appropriate directions as to what that does look like, at least in respect for the people, for the full board, unless anyone has more to say. I do know that we are hoping to have deeper conversations with our governmental partners, and potentially for me, a strategy of this finance committee was maybe there is opportunity for finance committees to meet with other finance committees for future years, but not all of our governmental bodies are in the same fiscal year. So that is some of the answers to some of our questions are maybe not immediately answerable. Okay, so Jim, you said you had something, Jared?
So we missed a meeting and we got allocated a $150,000 contribution. It seems like this heck of a meeting to miss. And I would just suggest that as we sit here, and again, I went through the township. We talk about tough times. 2008. This is way worse. That was way worse than whatever we've seen thus far. And 2008 was a devastating period. The township came through perfectly fine. They levy every year, and we had a good fund balance then, and so they still do now. I would just say that of the 2.7 million, 1.1 million is undesignated, which means it is totally free. It's just being held there in reserve in their fund, in the town fund. So it's sitting there. So I'm very familiar with that. I would just suggest between the River Forest Township and the Oak Park Township, couldn't there be a conversation, like we talk about, like we're not bringing them in, it's not my job to bring them in, we're just looking at something very specific here, but other people, maybe talking to the supervisor or the administrators over there and saying, look, I mean, this isn't, we're being asked to contribute 15 times the amount, and there really isn't, unless there's some plan to build something that they're not disclosing. There's no need for that. We were chastised back then when we had $3 million back in 12, 13. Why did we have that much money? Well, you don't need that. You don't need that kind of reserve. You've taxed us and all that. So anyway, it's just a thought. Maybe it's worthwhile.
I'm not trying to cut you off.
No, I'm done.
I do want to move the meeting.
I'm done. Totally done. No more.
And also, we've also been on the flip side of where people look at our fund balance and not understanding all the obligations that we have.
Right.
Think that, and so I don't want to do that to another governmental body. You know, there could be very good reasons as to why they have the fund balance that they've got. And 5 months of reserve when when we don't know what cuts we're going to see. There might be some wiggle room here that I get from you, and so I'm not discrediting, and I've already communicated that I want to have those conversations multiple times, and have reached out. But unless any of my colleagues are going to say, hey, maybe we should advise a second look at this, we otherwise have the direction from the full board that there is commitment to this, and so if we were going to advise differently, then the language is a little bit like we're still struggling with where our funding source is. Under $50,000 for at least this next coming year. This finance committee is something that we want to see meeting more year round than just the budget season. So we can still have far more conversations about year 2 and year 3. Let's get to where we might want to see this taken from. And if there's anyone else that for me, my questions on the $250,000 for alternative response is not that I don't want to see that, because for me, the alternative response is very important. It's part of what I ran on. It is a commitment. What it looks like has always been with CESA and with our partner agencies where most of the conversation exists. It's an expensive investment. It's an investment that we also see, have always talked about how is this maybe potentially lowering our rising costs in other areas of our budget, like, fire and police. So, John?
It's a 3-year program. You say we're committed to 150, but if I was that organization, I don't know if they'd want to create that organization knowing it's only going to have 1 year of secured finance.
No, so right now we're just finding, ultimately, all 3 years would be in our 5-year strategic plan, but it's just that, that a budget is a little bit, and I don't know that everybody loves it when I use this terminology, but living document, and that we're constantly making amendments, right? Sure. So, any thoughts that folks have had on this that they want to communicate?
I guess one of the things I think we see year over year is
savings.
We budget a certain amount, and then we see significant savings where our expenditures are far less than the budgeted amount. So, for instance, looking at the 2025 amended budget, we budgeted appropriations of $144 million, and our projected activity is coming in at $107 million. So, $37 million in savings. Are there things that we're budgeting for where we know that we're sort of we're holding a number there, but that we're not going to be able to spend next year, where we can make functionally a budget amendment now, the kind of thing we do next year, where we move money around because, well, you know, we see that we're not going to be able to spend all this money that we budgeted for this thing.
Always. But municipal government doesn't allow you to say, you know, we have this number of employees, this number of vacancies, and we're not going to be able to fill, you know, a certain percentage of them for 6 to 9 months. Municipal budgeting doesn't really allow you to take that into consideration. It's frustrating. Please jump in.
Yeah, so when we budget, when you see a variance between revenues and expenditures, remember the first quarter of the next year, you have a huge budget amendment. And that's where that was money that was not spent. So if, for example, if we budget $100,000 and we spend 80, that 20,000 goes to fund balance. And then in the first quarter, we have $20,000 worth of budget amendments. That's the $20,000 that we didn't spend. So we don't inflate the numbers. So where you might see a savings now of X amount of dollars, the revenue didn't come in, so therefore the expenses wasn't there. Part of what was in the budget for 2025 was that $32 million that we talked about for streetscape. We didn't draw anything down. We didn't take the bond, and it didn't happen. So it will wash itself out. So yes, we do have significant amount on some years, but we also are carrying it forward to the next year.
Yeah. So 2025 projected activity, we're looking at estimated revenues of just under 95 million. That those estimated revenues don't include the second half tax payment.
Yes, yeah, it does.
It does.
Estimated revenues of what we are expecting to come in based on the budget. So yes, if we say that we levied $18 million, we're looking for that $18 million, and that it will be in that estimate.
Okay, so that estimate includes that Cook County is going to let me pay my taxes.
Yes.
Okay.
Nice thought, though, but yes.
No, I'm trying to, our appropriations for 2025 are 37 million less than expected, and our revenues appear to be 33 million less than expected. And so I'm trying to sort of understand, because this has been a feature every year where I see we spend far less than we expect to spend, and so it makes me struggle a little bit when I know there are line items that we're not going to spend. And so it seems like we should be able to shift from a line item that we know we're not going to spend, when many of those line items would easily cover the $150,000.
Yeah. I would have to take a look at the line items you saying we're not going to spend, because if we budgeted, we meant to spend it.
We meant to spend it. There's a year-end estimate.
Right.
And so we don't really know until we settle up, after the end of the year. So everything is based on a year-end estimate. So we may not know right now that we're going to have savings at the end of the year on a particular initiative or project. So we estimate that we're going to spend 100% of it, but at the year end, we understand that we're able to maybe 95% of it. But
and 5% might have to go to the next year as a budget amendment.
It could be a carry forward,
right?
It could be a carry forward. The project's not finished, so some of it could be carried forward. But I would say, just at a high level, on a systems basis, inevitably in municipal budgeting, you will have some year-end savings that you true up on at the beginning of the next year, that Donna's speaking to in the first quarter. It could vary, so it's not reliable, right? Because it could be hardly any at some point. It could be substantial at some point, depending on the situation. So it's not something that you want to rely on. But certainly, you could, look at that as an opportunity to say, hey, if we do have some year-end savings, could we prioritize for this, and that, while still trying to make sure that whatever obligations you have are still intact. So you could look at it that way, but in terms of trying to estimate what that year-end savings is going to be before you settle up in the new year, right now, it's not customary and it's very difficult to do. Probably not supported by good financial practice either. But I think I really wanted to speak to it because I think that from a system standpoint, year to year, the amount of savings you have is not encumbered and carry forward, but just goes to the fund balance could vary to go up and down. But if you do have some, you could decide by policy that say, hey, look, you know what? We don't have enough structural funding to support affordable housing. So, any opportunities that we have or any savings that we have, when we understand what we're saving versus, carry forward and continuing encumbrances, we would like to prioritize some of that money to support our affordable housing initiatives, right? As an example. In this case, we're talking about once we settle up in Q1, if we have some savings, is there an opportunity to draw from that savings to support the living room initiative? Maybe.
Well, every year, I'm sure you go through a list of budget transfers where there are places that you spent more than you anticipated to spend.
Yes.
So you use that other side
yes.
to balance it all.
Absolutely.
Yes.
So that may not cover it all, but it does balance things.
We go back. I think if I remember, the original staff recommendation was this should come out of the levy. This is where the funding would come from. Since it's a short term, it's a 3-year maximum commitment. What about pulling from the fund balance? Is that not a good option? Speaking of reserves, we have a huge pile of money. I know some of that is committed, but I would love to hear more about why not that as an option.
Okay, sure. You want to speak to that again?
So a lot of the fund balance is committed, and as we go out to issue bonds, we want to keep as much of our fund balance intact. Considering where we are right now in this country, we have to be very careful how much we're taking out of our fund balance. We're talking about getting savings, adding more interest, but if we keep depleting the fund balance, the interest that we may have been saving may go up because our fund balance is not where it should be when we go out to issue those bonds. So that's why I really try to stay away from the fund balance as much as possible. And this year we have, for 2026, there's a transfer of $17 million from fund balance because what has not been done in the past is that when you do the budget in your other funds, they have never been trued up, and we trued them up this year. So, for example, the equipment fund was running, or better yet, your farmers market fund runs a deficit every year, and this past year it's $134,000. Well, that $134,000 has to come from your general fund to fund that program. And then when you look at your CIP, which we will go over in a moment, you look at your CIP, your equipment fund balance was about a negative $1 million. That comes from your fund balance to make sure you can get what you need. So this year, we trued everything up. And so that means that the fund balance is going to go down some because we are looking at the budget as a whole, not just as the general fund.
For the sake of time, as long as the commitment in the room is remaining with this $5 million, I do suggest that we just commit $150,000 from the general fund, and the finance committee in the new year look at those opportunities of identifying where savings consistently tend to come from, and then where could we create policy that then contributes those to relevant revenue or like the housing fund, sustainability fund, those funds of which then we can have, we can start to budget then our goals with parameters of some degree, based on then how those predictable revenue sources, but potentially new ones. So for instance, as we say, I'm not recommending this today, I'm not, but we heard from Cheryl that to some degree we hope that the living room would lower our EMS calls. So then to see what savings that might come from different areas of our fire department balance. If we create policy that then says now we want to see that in the future savings automatically be put towards a alternative response revenue or fund, or is it anything then related or affordable housing fund? Anything that any savings that might come from the Public Works Department, could that potentially be contributing to our sustainability fund? Then as we see ourselves budgeting into the future, we have an idea of what we should be, planning for, to have to spend, instead of having projects that then instead, so then you have budgetary restraints that you're trying to work with.
I mean, it's a systems level kind of a way to think about it. I mean, it's not just this is this budget and this is this budget, they impact each other. So that approach, it logics to me, knowing what I know, knowing that I know the least of everybody in this finance meeting. But it makes sense to think about it in that grander scheme, if we can, if that's something that is feasible from staff's perspective to look at it from that lens.
But it needs to have a lot more thought to that than what I just laid out. That was extremely generic and might end up being otherwise irresponsible if we just decide, but this committee can take that deeper dive and analysis into those spaces. Yeah.
Couple things here. And I'm going to bury the lead, so just bear with me. The NAMI statistics, and I know we went over this at the board table, but I do think some of these bear just mentioning really quick one more time, as soon as I find it. Okay, here we go. So we have here nationally, studies have demonstrated that between 84 and 93% of liver room guests were deflected from hospital emergency departments. Locally, not here because we don't have one, but LaGrange and Summit saw a situation where only 1.37% of guests required hospitalization after going to the living room, right? So over 98% were deflected. And I just want to point out, right, this is a very effective program, right? So, finding a way to fund it, I think, is paramount. That said, I definitely hear the concerns raised by Trustee Tackler, and I don't disagree with some of them around Scope Creek, right? I don't necessarily know where the village ends and the township begins anymore. And and I can say that for a number of local governments here. Right? I don't know where the library ends and the township begins either. Right? It's all kind of murky. I would prefer a much cleaner separation of duties. We don't have that in this village. So that said, the earlier item on the bonds, the bond refunding, happens to have a savings of $450,000. Right? Problem solved. Yes.
That's not money you get right away, though. That's savings over
time.
over like what, 20 years, something, 15 years.
Yes, we just pay it back.
I mean, general funds. It's like,
yeah, seems like it works for me.
And if we were budgeting for our household, we might consider it more. So
Well, actually, I wouldn't for my household because I don't have a time horizon of like 30 years at home. Like the village has to a time horizon at least of 30 years.
But basically, if the will of the board is to move forward with this program and to commit to the $150,000 a year, then then I would suggest that we, for this year, use the general fund, and we're going to have lots of ongoing conversations, including additional revenue sources that we're pursuing, but I trust that the intelligent people in the room are otherwise letting sink in that we're going to be challenged if we saying yes to everything all the time, and we need to, and that's to ourselves. When we have projects that we want to do, we're going to be challenged in saying yes to our own projects all the time. But if this is the will of the board, then there's no reason to keep debating it. Okay?
Just a clarification. So when you say the general fund, are you saying preference would be to take it from the fund balance this year?
Yes.
Okay.
Yes.
Okay.
Yes. Not to levy for the dollars, to take it from the fund balance.
Okay.
We just have direction.
Yeah, that's you. We have action.
No, we are taking, this is the direction to then put on in the budget for,
You can make your
yes. Yeah. Yeah, because we have, it's 9:30 and we have the CIP to discuss. At least we have discussed it multiple times in the past. And love to stick to the 30 minutes, if at all possible. Oh, wait, is everybody presenting again?
No,
God.
not necessarily.
Not that I don't love hearing talk.
You want to be able to answer questions
Thank you.
and at least be able to explain Don and Rob kind of what's being presented. So we had the original draft. The Finance Committee provided input on the original draft, made some suggested changes. We've updated the original draft to reflect those changes. But we've also added a couple of different scenarios in addition to the previous draft that you gave, the original draft that you gave direction on. And so those scenarios include, one, preserving what you directed on FY26, but looking at FY27 through 30, the out years of the plan, bringing it down to just essential needs, subject to further review in the next budget cycle, where you could consider whether you want to stop at essential or whether you want to add to essential based upon what the financial situation is at the time. Part of the reason for doing this is to really provide additional information about what your debt capacity is after covering what you're committing to in 2026 and the out years, we want to really create a realistic picture of what you might be able to afford in terms of issuing debt to support the capital plan from 27 through 30. So we felt like presenting you with this scenario where in the out years we bring down the estimates to just cover the essential needs, knowing that the out years are really just a plan. Each year you consider the budget in terms of appropriations for the upcoming year. And so even though you adopt this 5-year plan and you appropriate for 2026, that in 2027 you're going to be looking at the budget again, and so you're not necessarily beholden to just the essential level. You could consider other projects based upon the financial situation, and you can do that every single year as you update the 5-year plan. So there's that scenario. The last scenario, I think,
This is the 2027.
is looking at
This is 26.
just the essential needs for the entire 5-year period, 2026, with one exception, that since the Oak Park Avenue Streetscape project is already on its way, we've received bids, scheduled for to start construction in January, that we would preserve that. We preserve that along with the essential needs in 2026 in that last scenario, and then every other year is just essential estimates for covering essential needs in the out years. So I think what we're looking forward to tonight is for a recommendation from the Finance Committee to advance the CIP to the full board for consideration. So if you happen to land on your revised original, the revised original draft, that's fine. If you consider an alternative scenario, we certainly can help you advance that as well. So, Donna, anything else today?
You covered it well. Thank you.
Okay.
Any questions on what you heard?
I have a question.
Please.
So this is high level, right? Executive summary. Is there a detailed version of this on what the Finance Committee has already committed to keep versus defer? Because I haven't seen that document.
That might be easy.
I've seen the proposals, but I haven't seen the
whole CIP.
The kind of integrated.
Yeah, you can correct me if I'm wrong, Rob. We did it at a high level for the essentials, and so whatever plan they have, they will make sure that the backup matches the plan.
Gotcha.
We do have a copy of the original CIP though. Did you receive that one?
I do. Yeah, I have that. Yeah. So I was curious if changes, deferrals were made that aren't reflected in the original plan over the course of the discussion at the Finance Committee. It's just those items in the legislation text?
Yes.
Okay.
Yes.
Okay.
Yes, that's what we talked
So
about.
those are the changes that you guys recommended the last time.
And which version is that?
It's okay. So it's version 2. However,
V2?
yeah, version 2. However, there has been a few changes in version 2 because some things came in. I called it version 2 from the original version 2, and then essential 26 through 30, essential 27 through 30. So the numbers in version 2 are slightly less because there was some savings that was captured.
Got it.
Yeah.
Thank you, Donna. I appreciate that.
So this is version 2. So you see that you have to keep in mind, though, in version 2, the way the plan is, it's 32 million in 27, 31 million in 28, and 29 million. And I trued everything up, which means you have to borrow the money or take it from fund balance because you're already issuing a bond. So that's why village manager said, let's look at the essentials. And this was the essentials 27 through 30. And you see it starts to drop down, 15, 12.
Got it.
But 26 stays intact.
Yes, 26 days intact.
All right. Was anyone,
It's really, it's much easier to talk about the 48 million than the $150,000. I'm sorry, I should.
Yes. Yeah, I think there were other nuances being debated. So I'm wondering, is the question on the table that our members of the Finance Committee and members of the board, but I think because of the ongoing dialogue, members of the Finance Committee, considering looking for additional cuts? Yes.
So I have a question on the difference between original and version 2.
Yes.
Because we added in the fire truck.
Yeah.
Mm-hmm.
We took out the $2.2 million in cuts.
Yeah.
And those two largely, my understanding was offset, but the total expenditures ends up being
Less.
about $2 million less. So what you
There was some
noted-
savings. There was some savings. Some things came in when they made some adjustments. So it came in $2 million less.
Okay,
in
so
there.
all the projects that we previously discussed are in there.
They're in.
And we have realized $2 million in additional savings. So we are, we added a fire truck and.
Yeah, and I would say what
Yeah.
it could be
Yeah.
that something came in, the bid came in lower than anticipated.
That's good news.
Found a fire truck in the couch.
Yeah, we should be happier right now.
Let's just flag that that's good news. We saved $2 million.
Whoever did that.
Yeah. Do you guys have a perspective to share on that? Because
No, I mean, we haven't really been bidding out projects or updating projected revenues or expenditures for 2025 between the last finance committee and this, so.
It's 26.
26.
So,
There were some changes.
So they're not sure how that came about.
Yeah.
I mean, we did recently bid out the Oak Park Avenue project, but that was Monday. And those numbers aren't reflected in this.
No, but there were some changes.
Yeah, but I think most of those changes occurred on the finance side as you guys were, the 2026 numbers outside of the projects where we realized the $2 million savings. There were additional changes that were made on the finance side. I think it's just as you were truing up numbers around the other additional costs that go into the capital fund, right? Because the main capital fund is not just limited to the projects that are discussed in the capital plan, and that's where you're seeing that change primarily occurring. And I think that was primarily some adjustments made on the side of finance, either through adjustments on fund balance or salaries and other expenditures that are in capital.
So, yeah, okay, so we'll follow up with some additional communication on that to specify that, but we did anticipate the question that you're raising. And so the projects are there, all of them are there. So apparently there's some savings. We'll clarify what that is. We know that what we learned from the streetscape is that there's some additional savings anticipated as well, since it's not cash here.
Yeah, and it's also important to just remember generally, right? Like that all these sheets are moments in time when we're building this process. So like the original sheet that you're looking at is a sheet from back in early September. And then the sheet version 2 is from early October. And so there are a lot of changes that happen over time as we continue to move through the budget process that can be reflected in changes that become somewhat significant. But the overall picture, I think, is what is really the direction that we're looking for. But there's also the possibility, just like to Bill's point, I mean, we're bidding out projects, so there's potential impact both positively and negatively that will continue to occur through the end of this process as we kind of start to see how the projects actually start to bear out for 2026. Ridgeland Avenue, for example, is slightly over budget, but then Oak Park Avenue is coming in under budget. So like there's all these kind of changes that start to occur. So I wouldn't focus so much, I guess, on the smaller end of the numbers as the bigger end of the numbers.
I mean,
but
$2 million of $50 million is about 4%. So that's.
We just debated $150,000.
So,
yeah.
So
Call the spike check.
I mean, I guess that's all to say. In addition to like being happy, I think I'm comfortable with going forward with version 2. That's what we had sort of discussed previously. My understanding is version 3 or version 4 would mean going to some of the more significant cuts that we were looking at the last meeting where we were talking about CIP or deferring.
Yeah, so version 4 would, because it would trim 26 down to essential but still preserve Oak Park Avenue streetscape. Version, I want to make sure we got the right labels for the version.
Right. So This is version. This one is the essential 26 through 30.
So that version would trim 2026.
Right.
By 7 million.
By 7 million, right. So, but there's a version before this that preserves 2026.
Yep, that's version 2.
Version
which I was saying.
That's
no.
That's this one.
The
2027. So here's 26, and then it starts to reduce.
What's the label on it though?
Essentials 2027.
Is it version 2 or?
Yeah.
Yeah. Version 2.
So version 1 is the revised original. I just want to make sure.
I thought version 1 is.
Version 1 is the original finance committee presentation that was made. Version 2 reflects the addition of the fire truck and the removal of the projects at the direction of.
And so version 2 is labeled version 2.
Yes. So version 2 is what came out of our last discussion.
Yes,
that's correct. So then, the only thing that's changed are the things that you recommended there.
Right.
But the caveat here is that 27 through 30. If you look at it, can you?
27 through 30.
27 through 30. So let's look at the
right here
estimates for the project for 27 through 30.
That's it, right?
Right. This document is informing us what the essential costs.
Yes.
In 27 through 30 are. With my understanding is with the understanding that as we get into the next, but that we're not adopting a CIP saying for future years we're only doing essential costs. This is information for us that as we adopt the CIP, these are the essential costs in the out years that we're committed to. Is that how I'm interpreting it?
Yeah, you're interpreting that correctly. I think where we're getting mixed up here are with the labels, which was version 2. Yes.
So this this version, this essential 2027-2030 is actually, he called it version. It's V2.
Yes.
But version 2 actually has the words written on it. Says version 2. I think what
But Trustee Strauss, this version is the one that you're speaking to that you would support. The version that preserves 26 and then goes down to essential in the out years, subject to further review in the annual cycles.
I guess I'm only speaking to committing to the 2026. I'm not. I mean, I don't think we've had conversations sufficient to evaluate the future optional. This is a spreadsheet. My understanding was you were providing information about what was actually the essential so we can understand the future year's budgeting, but I am agreeing to, I have no idea what version this is. It says version 2 on the sheet.
No, so this version, when he labeled them, I think he's
V4, but it's version 2 when you spell it out.
right.
Yes.
So
the label.
Yeah.
Okay.
So-
before, yeah.
Yeah.
So this one, what's the 26? Because this has another like $1 million in savings over what we were just discussing in the one that's labeled version 2, but isn't actually version 2.
This is 48. So this is from the original, right after the original. Then you have
Can we stop there?
Yes.
So this is the one where they recommended the changes to.
Yes.
Okay. So this reflects
What that one
your
is-
changes.
The 48.9.
Right.
Right.
Yes. Yeah, we understand that.
So if we didn't run any other scenarios, this would be the scenario that we're bringing back that reflects the changes that you recommended at the last
That's,
meeting.
we got it.
Okay.
Okay.
So then,
No?
No, so the other one
Have $1 million more.
had $1 million more, and we were just discussing that we saved $2 million, added a fire truck, and that's where we ended up with 49.8. And now you're telling me 48. I don't know what, because we have no detail behind it. I have no idea what these two spreadsheets we're even talking about are.
Okay.
yes.
So when it comes before the village board, we
Yes.
No,
We'll relabel them.
I think it's simple enough today. I think we should resolve it. Certainly we'll relabel it, but of course, I think we can walk through this
Yes.
so that we want to make sure you guys understand the original version compared to the updated version based upon your suggested changes compared to the alternative scenarios. So,
All right.
okay.
So you want to go to,
This is the original.
So that's the original.
It started off 51, and then it's 31, 31, 32, 20.
Yes.
And then we went to the actual version 2 went down to 48, and then 32, 31, 32.
okay, but that's your version 4.
Four,
in our-
yeah.
In our,
Yes.
Yeah, it did. The numbers got mixed up when I
Gotcha.
see.
so what's version 2?
This is version 2. It says version 4 behind it.
And
26 through 30.
And this is not limited to essential in
No, it's just making the
It's not.
changes that was
Just made
asked.
the changes that you guys recommended.
Right. And then we did the essentials, 2027 to 2030. And this one here is leaving 26 intact, but it added a little bit more to 26, but everything else dropped down.
All right.
And then the last version was essentials only, 2026 to 2030.
So
And it left
You just
the,
want us to know what that difference is.
yeah,
I got you.
yeah.
Okay.
And the main reason it was done is because when you look at the original and you look at version 2, these numbers right here, you can't afford them unless you borrow.
Okay,
Say
well,
that
I
again.
mean,
You can, this right here says $32 million. We trued up.
Right.
So once we true the CIP up, there's not $32 million out there.
What is, I know you explained it earlier about true up, and this is probably just a place where my knowledge is lacking. But I thought that running the budget on the fund level meant that there wasn't a true up. Like if it went
We have to
negative, then you have to borrow, but it's like an IOU goes back in the fund.
It's an inter-fund transfer. CIP is typically, you have a CIP fund, and the only enterprise funds that you have is what? Water, parking, and environmental services.
Okay.
So when you do the CIP, which is in the general fund, we just move money from the general fund balance to cover those expenses. In the past, it's never been done on the budgeting side. So when you see excess revenue over expenditures on the general fund, you may have other funds that are listed or other funds that, have to be balanced out. So we had to balance out like the equipment fund because it really didn't have money to buy equipment.
Got it. So the equipment fund might be paying $3 million, and it doesn't have $3 million. That money gets transferred from the general fund. That was always the intention. It just was never reflected in the paperwork.
Right, and we reflect it so that we can make sure how everything happened.
Gotcha.
Yeah.
Perfect. Thank you so much. That really helped.
So I think what I will say is that I'm comfortable with the discussions we've had regarding the 26 CIP budget. I think it would be helpful to actually detail out what the projects included in the delta between the essential and non-essential for the out years are, because I'm looking at this and I'm seeing the difference between 32 million for 27, 28, and 29, and what is it, 20 million in each of those, 20 million, 15, and 12, and that's a very large delta, which undoubtedly encompasses numerous projects, which and so it's I don't think any of us are necessarily in a position to say A or B between those two.
I think the public works could talk about what essential means versus board goals.
I understand what essential versus board goals means. I need a list of when this comes before the board. I need like the list of what those projects are in those out years. Like point me to which sheets we're talking about in those out years.
So like the bike.
Yeah.
One thing, this is a plan. Plans always change.
Absolutely, that's
correct.
As we go through it. And the other is, the board's always going to have a second look at this because there's nothing in the capital budgets. It's probably going to require board approval to actually initiate it.
Yep.
Mm-hmm.
So, I don't know if that helps.
Other than that, we don't want to levy for money we're not going to spend.
So
well,
yeah. We always do, but not intentionally.
If it sounds like a reasonable plan, then it gives you something.
I got you. Right.
So what I'm asking tonight is which plan do you want to recommend to the Fort Village Board for consideration?
Well, okay,
do
so
you want the revised original that preserves 26 and all the projects in the out years, this is the one that's up here, 32 million in 27, 31, almost 32 million in 28, 32, 33.
right. So you're just making sure we comprehend is that all of our board goals above essential are things that outline costs in latter years are things that we can't necessarily afford.
That's correct. So we're not, I'm telling you right now, a $30 million a year capital program year over year for after 26, you may not have the capacity to afford that. Your debt capacity may not be able to handle that.
Mm-hmm.
So one
but
way
for us
to look
to have
at
a
it,
functional conversation about that right now, I think what I'm hearing from Brian is then, other than by memory, related to our board goals, we'd like to know what those projects are and the options that we consider. So the one that we probably have the freshest in our memory, which the chart doesn't spell out, is that we had the bike plan that had work that we would see happen in 2026, see in 2027, see in 2028. And we made a conscious decision to actually try to expedite that. And you are potentially suggesting we should consider maybe putting that back to the original plan of where we see that bike plan take additional years to be implemented so that we can, just to make it more affordable. But that's just one example of potentially many.
Yeah, so that's where I was going with, when you look at the alternative plan in the out years and you bring it down to essential, just covering essential needs of the village from 27 through 30, yes, it would, from a planning standpoint, it would remove some of those projects that were prioritized in the original plan. Pending further review and a better understanding of whether what you can and cannot afford, right, in the next budget cycle, right? So,
But okay, so
Mr. Hedges said, like, the 5-year plan is a plan. 26 is your budget appropriation, right? So that's what you're actually budgeting for next year, and is 2026. But in the out years, that's your plan. Your plan is subject to change every year based upon a discussion about priorities, what you can afford, and so forth. And so if you adopt a plan that includes preserving 26 and then a $30 million annual program for the next 4 years of the plan, what I'm suggesting to you is you may not be able to fund at that level.
Right. Okay.
Right.
Well, when you say essential, it's inclusive of the commitments that we already.
It's roads, it's it's sidewalks, it's right.
So,
alleys.
no, specifically, does essential include, the commitment to, and we're making in 2026 to non-essential projects, and now you've committed them and now they're becoming essential? Or is essential literally just streets, water, sewer, sidewalks, responsibilities of municipal government?
Responsibilities of municipal government. And that's what I said, we're prepared to talk about what that means tonight.
Okay, well then we need a vote to go past 10 o'clock. And I entertain a motion to go past 10 o'clock.
So moved.
Very enthusiastically. All in favor?
Where this is headed.
Aye.
I don't know what the answer is.
Okay, so, but we need to frame this so that we can be decision makers, though. So, and when we're making decisions on projects as a one-off at the board table, like the fact that we're committed to bike plans, but we're not having that discussion in the bigger context, then that I think we need to in the future have those budget discussions so that then our goals have limits. Because this is kind of setting us up to commit to things that then, and now with a lot less detail, we have to rein back in. So I do think in future years we need to have parameters on our board goals. But go ahead.
Is it feasible to put more of this discussion on to Thursday night's finance committee? Because I say that because I'm happy to have staff come up and explain what essential means and what essential doesn't. I need details, and the information that staff has given me here, in addition to being confusingly labeled, does not include sufficient details for us to make an informed decision. And I am not prepared to make this decision and have this vote based on it, not a vote, a recommendation, direction, based on the information put in front of us by staff. There's $54 million over 4 years worth of projects that are different between version 2 and the other version 2. And we need to know with some specificity, because I don't think ultimately this decision should come down to essential versus everything. It should come down to smart budgeting that includes something in the middle. And if you're saying nothing beyond this year is actually a commitment, like that's true, but you're asking us to make a decision on what we're putting before the board as far as CIP beyond this year between one of these two things. So if we're going to do that, we should do it in a nuanced, intelligent way where we're actually considering what those $54 million worth of projects are, and we've not been given the information to do that. So I would ask to table this conversation to Thursday because we do not have the information we need as a board to make a reasoned decision.
Yeah.
Can you get that? Is that achievable? I mean, these are just, I don't think this is.
The out years are just plain. It's just they're not.
I'll say again, it's a plan, and that plan trying to do what you want to do, but what you want to do is probably going to change. So if you get too much specificity, I mean, you're going to put a lot of energy into something that gets a little fuzzy on the after.
Sure, but I'm being asked to decide between those two plans. And so if I'm being asked to give direction between one of two plans, that means that they think that direction is actually meaningful and useful to them, and I should actually have the information to make that decision. I agree with what you're saying, and I think that we can potentially put off evaluating future years' budgets for future years. But we're being asked to put together a plan for 27 through 2030, and we're being asked to do it based on one-pagers that don't tell us what projects we're including. And I'm not prepared to make a decision.
This is a demonstration, I think, more than it is.
It is. It's a cautionary tale.
It's a cautionary tale. And no one's going to go in that direction. They're going to take the most aggressive approach, and we're going to get stuck with a big bill.
Yeah, I think we need to review what the order of which the Finance Committee received information this year. We spent 2 days going page by page by page of the CIP before hearing our strategic, limitations on our budget. And it's like we need to have that review.
Yes, and we were told the CIP was staff's recommendation.
Yeah.
And now we're being told at the end in a summary chart that it's unachievable. And so, I can't make a decision based on this.
Well, I think, so there's a little bit of a mix. These are board goals, right? So this is not just a staff recommendation. So the bike plan, Percival Julian.
But when our board goals come forward to us, they should have limits.
This is not staff coming up with this stuff and saying, hey, could you please do this?
Well, as I was told,
these are board goals that have been directed
at the
year over year,
at the pleasure of the board.
Decisions about
this is what they're presenting as your pleasure, and it's not a pleasure.
No, Jim. No, I'm sorry. When we say that we have a board goal of being a bikeable, walkable community, along with that would come, but as you're going to learn in the budget season, you really should try to keep that that bike plan to 5 million instead of 12 million. And I'm pulling those numbers not out of my memory because they're not in front of me. And we should be making the decisions then with those parameters. Of course, if you put us who are ambitious people with ambitious goals, a beautiful plan in front of us, we're going to go for the beautiful plan. So I think.
Well, I had a recommendation on the firefighters.
We're not going there.
Well,
we're not going that.
But it's still moving. That's what I'm saying. These are priorities of the board, and I think they're priorities that have to be collectively analyzed by the board to decide what trade-offs.
It feels like there was staff excitement about some of those board goals too that contributed to us in this situation, and that's fine. But this,
I think this,
if there's a way to constructively have this conversation, if there are then I'll give that opportunity for a moment. Otherwise, I would entertain Brian's motion.
Yes, and I think that's fair. I mean, we can have as many conversations as we need to, and I think we have the information that Brian's looking for. And I think in addition to that, we should provide information on what the debt capacity looks like, 27 through 30 as well.
Again.
That would be helpful. That would be a helpful detail.
Step A next time. Okay? So, yes.
Just so I get, just trying to get my head around this. I think your issue is that because we don't see the projects, we don't know what was deemed essential versus non-essential, and you don't want to vote for something that is endorsing a removal of a project that you might support and would rather trade, right?
No.
No? Okay.
No. My issue is we're being presented A or B between like the kitchen sink and austerity. And most likely we end up somewhere in the middle where we do some projects and we budget with a scalpel instead of with a mallet. And we're going either essential or everything.
Right.
And so looking at what those $54 million are, I don't think you're telling us $225 million over 26 through 30 is the maximum we can do, because $225 million is the version 2 where we keep 2026 but do essential everywhere else. But I think you are saying 279 million is beyond what we can do. The delta is 54 million, and probably the solution is somewhere between the two. And it's making decisions about what priorities we prioritize, and we cannot do that based on A or B.
Gotcha.
We have to understand what we're giving up, what we have to defer, how we have to move those dollars around to effectively prioritize our priorities. And we're these instruments, if we are being asked to decide A or B, instead of it being just an exercise in informing us that we have problems in out years. If this is actually, we have to make a decision as a committee between these two options, then we need to take a scalpel. We need to take a nuanced, deep dive look and sort our priorities and push things out that need to be pushed out and understand what our debt capacity is and understand what numbers we should be targeting in each year to be achievable.
I second
that's not what we're doing.
Right.
This is not an effective way to have a conversation.
And about 6 meetings of
And one scenario, now you're going to do this over a 10-year period. How about?
Can I make a recommendation?
We didn't present that as a scenario, but that's an alternative.
Yeah. So when we do come back together to talk about it, can we make it a committee of the whole for the finance committee? Because I would like to have Greg's and John's input as well, but I don't want to have this discussion again once it goes to the village board, right?
No,
if we're going to have this whole thing, let's have it with everybody present. Yeah.
I would caution. Well, okay, so maybe that just needs a moment to let the question sink in, because on one side we've got what has proven to be cross-representation of goals, in that, not to label, but Derek and Jenna share a lot of the same goals. Brian, Jim, and it's 4 voices plus versus 7 voices plus. That takes a 3-hour meeting and hopefully keeps it from being 5. And and if we can really put our
really be fair to our colleagues, because I trust us to be fair to our colleagues, then we can still do this and have it not like divert the whole board from other work that we have to do in the meantime. But even though budget is pretty much it at this point, but at the same time, if we're literally going back to the drawing board, which is super frustrating, then I don't know.
Well,
I mean, we heard a lot of where the priorities were, but when we listened to it all the first time, but it is frustrating because I mean, we were paying for a $20 million streetscape that's now being bid out, and there might have been things in that streetscape that we would have reined into.
It's not too late. It's never too late.
I wouldn't change my opinion on the streetscape. I think we got rid of the blue stone, so I'm good.
There's another
What was the other thing?
There was another thing. There was $1 million. What was it?
It's a lot of
But
words.
Hey,
Blue pavement.
It's I just,
Okay,
I just,
fair enough.
I want whatever plan you adopt, just remember that what you're adopting in the budget is for the next fiscal year. And the out years is just a plan, and it will change. It always changes. It's subject to change. So in essence, whichever one you adopt, even if you adopt the original version that has all the projects in there from 27 through 30, when you go through the budget cycle again next year, you will be reevaluating those projects in the context of the financial situation at the time. Right. And so you're not adopting. So when you adopt the plan, you're not appropriating funding. Those out years are still in the budget.
There should still be a plan that we should feel good about, right? We shouldn't just say, well, it's this. We'll figure it out later. It should be something we can stand on.
My thing is but the part of this context is that you are still working through a financial strategic plan, which we continue to talk about, that it's important that we go through that process in the context of some of these larger commitments that we've made with Streetscape, Police Station, and go through that process to figure out how we can continue to manage and support some of the goals that the board is interested in. And so that has to happen. Right. It's in play. And those conversations are going to take place in the first quarter of 26 after the budget process is done. So
maybe it's...
So if we're doing financial strategic planning for the FY right now, then that will certainly alter the schedule. But if we're trying to identify a budget for FY 26 and then moving into finishing out the financial strategic planning, that will set us up for 27 and beyond.
So
those are two different.
I mean, maybe it is adopting version 2, but with it flagged to we're going to have the much fuller conversation in quarter 1 as to what the CIP for, because it sounds like the conversation we're having right now is about a $54 million for 27, that's the delta for 27 through 30. And if that's the conversation we're having, and you're saying you don't actually need this information for this year, then we can have that conversation when we actually have the information regarding the longer-term financial strategic plan. But if you need this decision from the board between essential or what was previously presented right now, then we need to have a much longer conversation, and it seems like committee of the whole makes sense because other people are going to have comments. So I'm fine with if you're saying this information isn't actually relevant for you right now. I'm fine with us saying it should be a conversation we have in Q1. If it's something that you need or you need our input on, what?
Yeah, certainly in Q1 as part of the strategic planning process, but also as part of the next budget cycle.
Sure.
Yeah, even the first 2 quarters. You know, the longer range, take your time, find out what the board's direction was to be, then you can start fitting projects into it. I think that's probably what the staff has done. But, you know, that's where you really count on to put the program together. You tell them, this is our priority, this is what we want to do, and then they find a way to get it done. Then you have to actually come back and prove it and make changes.
And can we have these labeled properly even?
Yes.
So that when we come back.
Yeah, they will be.
Thank you.
Yeah, they will be.
I was just gonna say, well, is the motion to bring it back on the 6th? Is that too soon, or what are we saying here?
The 6th. That's
I could get the information from
Rob. Bill?
Rob.
Yeah. Can we provide the information that's being requested by Thursday?
Yes.
Okay, I'm not going to want to go line by line. I'm going to want bike plan this, like, you know.
Bigger buckets.
Bigger buckets.
We have all the optionality for already.
If that's the case, the real issue is what's listed as essential 2026 versus what we're talking about. Because those are there's obviously changes in the expenditures that aren't reflected in other ones. So there's a difference. The other ones are higher. So
Yeah, I mean, I guess that goes to the finance committee, walks through 3 different sets of cuts and identified 2.2
and so that's my point about the committee of the whole, right? Because you guys walked through
Well,
three
you-
different.
well,
I was there. No, I was there. I know, but I mean, my point is, had I not been here, right, like you guys walked through 3 different sets of cuts, and
Oh, we would have called you tomorrow, don't worry.
I will. There were many of them that I didn't agree with, right, which I expressed while I was here, which then would have just been me expressing those at the board table. And Chiefy wasn't here. Maybe he would have had things he disagreed with as well. I don't think you were here either, Jenna, on that meeting, right? She might have had things too. And all of a sudden, we've got like a finance committee meeting that you guys spent hours on that turns into an hours-long board meeting because half of the board wasn't here to discuss the cuts. And then when they looked at it, it was like, no, I don't agree with that, right? So if we're going to be in the weeds at that level of detail at this point in the calendar, I think it makes sense to have the entire board.
I wonder if it's understood where our frustration is. All the presentations have been fantastic. It's the order that is frustrating. Because when we were first looking at the first 2 pages of the CIP, we're like, looks great, looks great, looks great, for 2 days. Because we didn't have any budget restraints and we didn't understand that we were potentially looking at a need to start to be cutting to this degree. If we knew we were looking to cut, then when we looked page by page by page, we would have been making those mental comments to ourselves on what we should be cutting. Now I feel like we're going to need to do some of that again. I am clearly hearing John Hedges in that we might be just frustrated right now because there is always an opportunity to revisit our decisions. And I'm the one who always consistently says that, even when we are approving the bike plan and this and that. But even when we were, this is what I would expect for the future, even with the bike plan. Like, okay, board, we appreciate your lofty goals. We mock ourselves sometimes on our lofty goals. But as, you know, a village manager form of government, we need you to understand that you should consider staying within $8 million. You know? And that, and for us to be all excited and telling the community that we're committed to these board goals and we are investing in these, and now learn that we have to renege on some of that, not fun.
Well, I mean, I think that, you know, you have we deliberate over this, we talk about the fiscal impact of every initiative, the board decides when it votes.
I don't think we always do talk about the fiscal impact to the degree that we are understanding we need today.
We do. And I think that you still have an opportunity if you want to reconsider a different approach, like the board. So if you're still committed to doing the bike plan, the difference between, or some of those other initiatives is maybe spreading it out, or, you know,
I know, and we wouldn't said that at the appropriate time.
And so we know that ARPA funding was going away, right? We talked about ARPA being a one-time resource, it going away. We know that we've always talked about the fact that we have a dedicated revenue amount for the capital program at $5 million a year, right?
Which is way too low.
We've always talked about the need to issue debt at some point to support capital program, which is not unusual for cities to do, right?
I think the issue is at the beginning of this finance committee budget cycle, we talked about, like, should we be setting an actual, like, a levy target and then budget, like, working backwards to that? And the answer was no. We should go through and go through the checklist, and then we'll see where we end up on the other side, and it'll be good. And now we're on the other side, and it's like, oh, by the way, a $54 million difference in out years that we need to be talking about.
So I just want to be clear. We're fine for budget year 26, right? All right, I'm out. Tonight.
I would just say that it's clear there's too much lumped into 2026. I've said that. I mean, we've talked about it. It just seems that way. And it's just the way this thing has worked over time before going back where these projects got approved. When we talked about the bike plan, I was looking at the numbers, and yes, $30 million plan. And Bill agreed. I asked him, he said, it could be. I asked you
for a 10-year?
Yeah, for the long term. Which it is. I mean, I'm saying, but we have to pay for it over a period of time. I'm not saying it's good. We're good we're having these discussions now because this is it right here. And it just seems to me, if you look at the history and what we've paid over the years, and you can go back farther, we've never had a year like this. We're planning to expend this amount in one single year. That we've actually, just like it's going to happen, do it. Everything's lined up.
Yeah, I mean, the streetscape project, if you deduct that out, then it starts to look
more like a normal.
More like a normal.
Well, it's a lot to take on.
You know, and since Corey just left, I'll say he was the one who was often saying that streetscape's like an investment.
Yeah.
So if we could just get a document that is what this number looks like in projects so we can process it between now and Thursday, then maybe we can regroup and move forward without a whole redo here. And maybe a document that is the 42 number and what that looks like. And we'll try to come back on Thursday as prepared as possible.
I guess I would just add, in addition to the buckets that we talked about for, like, this is what makes up the projects that are missing in the out years. If you could include in that buckets, like, here are the CIP pages that you can refer to, so I can be flipping back to the, like, a cross-reference. So I can do my homework there.
I mean, you gave us four of these charts for a reason. Give us the information that helps us decide which chart we like. Motion to adjourn. Second. All in favor? Aye.